I'd like to call to order, please, our September meeting, which is a study session in lieu of our Federated Retirement Board and Healthcare Trust meeting. We'll just kick it off. Under orders of the day, we're just going to follow the order that's in the agenda. We have lots of presentations, lots of discussion. So the point here is our intent really is to have a great discussion, provide information, have some thoughts and dialogue here. If you notice, none of these things are actioned today, and so that's lots of discussion, potential direction to staff and to consultants and team about things. And so our point is to have a good, fruitful discussion on many topics and get going. If people in the audience have questions or insights that they want to share at the appropriate time, just come on up. I don't do the yellow card thing because that's a lot of writing and reading for me. So if you just raise your hand, come on up and announce yourself into the microphone, who you are and what your question or comment is, and we'll get going from there. So first up, discussion on the roadmap strategic planning for Tier 1, Tier 2, including the development of asset management options. Mr. Hallmark, is that you?
I think that is. Good morning, everyone. I'm Bill Hallmark, and with me are Jackie King and Stephen Hastings. And so we're going to work through this PowerPoint to go through a variety of topics. I would encourage you to stop us at any point and engage in a discussion as we move through. If we have a slide that deals with your question, I may ask to hold the question until we get there, but feel free to ask questions as we go along. So let's jump ahead. Go ahead one more to the...
And the only thing I'll caution everybody again about is make sure you're speaking into the microphone. If you want to be heard, speak into the microphone. If you don't speak in the microphone, plan not to be heard. So nice and loud so everybody can hear you. And that way that people in the back who are listening and people who are watching. So thanks.
Okay, so the main focus of our presentation is talking about the differences between Tiers 1 and 2 and how they should be managed going forward. They're currently managed very similarly. They have the same investments, same discount rate. We have some different assumptions and different amortization periods, but for the most part, they're managed the same way. The dynamics of the two tiers are very different. Tier 1, the key factor is it's a very large unfunded liability, and paying for that is a strain on the city's resources. And it's predominantly borne by the city. The members pay a portion of the normal cost, but any of the gains and losses get paid by the city. Tier 2, however, the members pay half of any unfunded liability that develops, as well as half of the cost of their ongoing benefits. So if a large unfunded liability develops, that it's going to put a burden on the member contributions as well as on the city contributions. So really the question is, should these two tiers with those different sources to pay for any gains and losses be managed differently, either starting right now or starting at some point in the future? Should there be different investment strategies? Should we work through different contribution methodologies? And we've done some on the contribution side with the different amortization periods, but really wanted to go a little deeper on some of those issues. So to get there, we're going to start by giving you some background on where we are, both for the federated system and the police and fire system, and how we got here, and what we've learned about how and why we got here, and how that might influence how we manage things going forward. Then we're going to get into more details about the different tiers and the comparisons. And really, Tier 1 has been our immediate concern because we need large contributions to restore funded levels, and that has a significant impact on the city's budget. The Tier 2 dynamics suggest that we might want to get more conservative at least when the plan matures, and there's some volatility in those contribution rates that would affect member contributions. But that's not going to happen for a while. And so we'll go through those dynamics. I think the general options we're going to present, and we're not asking for decisions today, but kind of a sense of the board of which general approach we should be pursuing with respect to Tier 2. We think Tier 1 is stay the course, but we'll revisit that and get your feedback on that as well. But on Tier 2, do we want to stay the course for now and address those differences at a later time? Do we want to make some changes right now to how we're managing Tier 2, both on the contribution and investment side, or one or the other? Or would it make sense to kind of plan a phase into a different strategy for Tier 2? And we could start planning for that now, particularly as the Tier 1 UAL is paid off or becomes less of a burden going forward. So those are kind of the broad strokes of the directions we're looking at and hoping to get some sense from the board on. So with that, I'll turn it to Jackie for some background.
So as Bill mentioned, we're going to do a bit of a comparison between the police and fire and the federated plan. So this slide shows, if you look at it, it's kind of like if you think of the systems as a tank, and at the top you have your contributions and your investment returns coming into the plan, and at the bottom you have your administrative expenses and your benefits coming out. And then the actual tank themselves, the full rectangle would be the liability of each plan, and then you split it out by how much is covered by your current assets and how much is unfunded, which is the unfunded accrued liability, which is the top gray section of it. So as a comparison, you can see, and they're proportional to each other in that the police and fire have a higher liability than federated, but they also have much higher assets, and a lower proportion is unfunded compared to the federated. And this is from our last valuation, and it's a comparison of the total contributions for the current fiscal year that's going on. And you can see also it's proportional in that the total bar is proportional to the total contributions being paid, but it's split out by the different portions of the contributions. So the bottom is the contributions being made by the members themselves. Then the next one is the normal cost, and you can see that police and fire have a higher normal cost, but then the next one is much lower for them. Federated has much higher interest on the UAL that you're paying. That's because you have that higher UAL. And at the very top is the UAL principal that you're paying down. So once again, that's smaller for federated compared to police and fire. This chart shows the funded status of the plans. So again, the bars are proportional in that the total height of the bar is the total liabilities of the plan, and the green dot in the middle, that represents your market value of assets. So you can see here, police and fire, they are 74% funded as of the last valuation date, and federated was 50% funded. One thing to note here is that the liability is broken out by the different portions for your actives, your deferred vested, your pay status, and your Tier 2. Although it looks like there's only Tier 1 here, if you look at the very top, there's a very light pink bar, and that's your Tier 2. So it is there. It's just this graph is just showing how proportionally it's a much smaller proportion of the liabilities at this point.
I think I'd also note that both plans have a significant portion of the liability is for people who are currently receiving benefits. So I don't remember the percentages, but it's somewhere around 2/3 of the liability is for people already receiving benefits. And so that presents a bit of a challenge because that means that the assets and the liabilities are very large compared to the size of the active population, and their payroll and our contributions to fund the plan are driven by their payroll.
This is a graph that I think most of you have seen before. We do use it in our valuation, but it shows the historical changes in the unfunded accrued liability. And what it's showing is that it's actually, oh, and this is just for federated. Sorry, this isn't showing for police and fire. Now we're switching to some historical for just federated. So since 2001, you can see that the UAL has increased from about 12 million to 1.9 billion. And if you look at each color represents a different reason for that particular gain or loss. You can see the biggest reasons over time. The orange bar with the yellow bar is your gains and losses on your investment returns, and at the top you're going to have a loss. At the bottom it's a gain. So you can see you've had significant losses with investment returns, and that's added to the unfunded liability. And then another big portion is the assumption changes, which are mostly due to the board lowering the discount rate over time. And periodically we do the experience studies. This year we've got one coming up. But those are the main sources for the increase in UAL over the last few years.
So I'd also notice there's more than just the discount rate that changed. And in particular, we had some consistent liability losses from 2001 through 2009. And then we made some significant changes in assumptions, both reflecting mortality, refund rates, and some other assumptions that were relatively aggressive before that. After that, on the liability side, it's been much closer to the actual. We've had some gains when there were lower salary increases and then losses when those were made up. But on balance, we've been much closer. So that's part of those assumption changes is correcting that past dynamic. The other thing I'd note is those small red slices for contributions. Those are contributions that are less than the treadwater rate. And so if you don't contribute the treadwater, the normal cost plus the interest on the unfunded liability, you're expected to build more UAL. And historically, this plan had used an amortization method that never paid normal cost plus interest. So there was always a piece going in. The only exception being when payroll grew so much that it accidentally contributed more. And so we've been working really the last 10 years to whittle that down and have just crossed that line to where we're paying more than the normal cost plus interest. So I think those are key pieces that we can control. Obviously, the investment returns, you're seeing the effects of the dot-com bust and the Great Recession hit in that period.
So what this slide is showing is the difference really between the current expected return, your discount rate, and an interest-free rate, which is usually the 10-year Treasury rate. And what you can see is the difference between them is the risk premium that the plan is taking on. And as you can see, since 1985, the implied risk premium was negative versus, as of now, it's grown to about 4.69%. So it's really just the extra risk you're taking on, the assumed return in your discount rate compared to the risk-free rate that's out there.
Before you skip to the next slide, I'd like you to dig into this just a little bit more. We have, mostly because we have a lot more people paying attention today than in typical slides, and so this is something that tends to be pretty confusing and is hard for people to soak in. And so if you could even take another whack at describing it, that'd be great.
Yeah, so this is actually a critical piece that has affected all pension plans across the country, and we're showing that what's happened with this plan. But when when the yield on the 10-year Treasury is 6.2%, like in 1995, you can assume an 8.25% return, and you only have to beat the yield on the 10-year Treasury by 2%. And that's much easier than today, even though we've dropped our discount rate from 8.25 to 6.75, but the yield on the 10-year Treasury's dropped even more to around 2. So we have to beat the yield on that 10-year Treasury by a lot more, which requires us to take on more investment risk. So what's happened broadly is as interest rates have declined, plans have had to choose between taking on more investment risk or reducing their discount rate and contributing more to the plan. And you, like many plans, have done a combination of the two. We've reduced the discount rate, demanded more contributions because of that, because we're not expecting as much in investment earnings. But even in doing that, we've had to change the asset allocations. I didn't go back and look at them for you, but I know for the clients that I have, you go back to the 80s and you're looking at an asset allocation that's something on the order of 70% fixed income, publicly traded fixed income. Nobody has that kind of fixed income allocation anymore because you can't get any yield out of it. And so if you follow the trend, you see a drop in the fixed income allocations and growth in equity markets, and then you'll see a shift to other alternative classes as well. And so every plan's done it a little bit differently, but the broad outline is that with the lower interest rate environment, we've had to take on more risk to try and achieve a return.
Thanks, Bill. And we'll talk more on some of this through the Makita presentation as well, and more specifics. But this is helpful.
Once again, this slide's for federated only. And this is showing your historical as well as your projected contributions. The top graph shows the contribution rate as a percentage of payroll, and the lower graph shows the dollar contribution amounts. So as Bill had mentioned a couple of slides before, one thing to note in the top graph is that the actual contributions historically, which are the dark bars, they've been lower than the trade water rate, which is the normal cost plus the interest on the UAL. But going forward, you've now reached that trade water rate, and you're expected to contribute an excess amount more than the trade water rate. So the contribution rate has been increasing over the last few years, but going forward, it's expected to be more stable, and then hopefully eventually we can get it to decreasing as the plan becomes more funded. But on the dollar amount, obviously the contribution carries on increasing, and that's just as payroll increases and the plan grows in size.
Before you go to the next slide, can you explain a little bit what you mean by trade water? I know Bill made a quick statement as to what he was referring to, but I'm not sure that to the average person they would understand what trading water means. And so if you can elaborate a little more on that so that it's understood, I think that'd be helpful.
Yeah, so we're just going back to this slide. You can see that your actual contribution is broken down into a few different pieces. So the bottom of your minimum contribution, the top three combined is your city contribution. And the different portions of it is you have your the portion of the contribution is the portion that's attributable to the normal cost, which is the benefits that are getting accrued.
Jackie, would you mind staying close to the microphone?
Sure.
Thank you.
So the normal cost is a contribution that's getting paid down for the benefits that are accruing right now. And then the rest of the portion is related to your unfunded accrued liability. So you have a portion where you're paying down the principal of the unfunded liability, but then you're also paying the interest on the unfunded liability. So When we're talking about the trade water rate, we're talking about the normal cost portion plus the interest on the UAL. So it's really those two middle portions of the contributions. So the trade water rate is really just an extra sub-portion of the contribution. So does
Yeah,
that make a little more sense?
understood. Yeah, I appreciate it. And just to be clear, and I think Bill mentioned this before, prior to this year, the city contributions included the normal cost and some interest on the UAL, but not the full amount
Correct.
to actually decrease the UAL, assuming everything else stayed the same, meaning that all the assumptions were met. That's what you meant before. So
Right.
interest was paid, but in this example, the total interest payment is 137.8, but in the past, maybe they, instead of paying 132.7, they were paying less than that. So then the UAL was continue increasing, assuming all the other assumptions were met.
Exactly. So the term tread water is meant to imply that that's the amount you have to contribute so that the UAL is expected to stay at the same level, the same dollar amount.
Okay.
If you contribute less than that, the UAL is expected to get larger. And you don't start reducing the UAL until you contribute more than that. And so that's been the process for this plan is to get above that level so that we are actually paying down the UAL and doing more than
Mr.
treading
Payne,
water.
I'd like to provide a little bit of clarity that's not, because the way you're wording it can be confusing. We set the contribution rates at a place that did not have additional principal being paid. It's not that the city wasn't paying it. It's, we did not
Correct.
set contribution rates in a way that would get to that point where we're, and so we had to work our way into it over time as opposed to, and that's where a lot of these changes have been, as you see, year by year, making these incremental changes, so we didn't have this massive swing in contribution. And so it was a contribution rate that we set.
Yes, thank you for the clarification. You are correct. It was said by the board. I did not mean to imply that the city wasn't making the full payment.
Right.
Yes, thank you.
And that
Okay, we got it.
transition is a portion of that rise in historical contribution rates that you're seeing there. And it would have been a significant jump to just go directly there, and so
Yes.
we took some time to increase slowly to get there.
Okay, Mr. Horowitz?
Mr. Chair, thank you. Just a quick question. What is the rate that we are assuming we pay on the interest on the UAL?
It's the discount rate of 6.75%.
Mr. Castellano?
And for those of us who haven't been around, why was it that the prior contribution rate did not meet the tread water threshold?
This is what he just stated.
Well, we weren't around when that was set either, but they used what's called a 30-year rolling amortization. So each valuation, they reset the amortization period to 30 years and using a level percent of pay amortization. So our amortizations are not like your mortgage where it's the same dollar amount each year. There's a built-in increase in the dollar amount each year. And by having a 30-year period with something around a 4% increase in the amortization payment each year, it meant that the first year payment was very small and less than the interest on the unfunded. And then you'd go to the next valuation and you'd reset that and do it all over again. The idea behind that strategy originally was that it gives you very level contributions. There's not much volatility in your contributions. And if your gains and losses end up offsetting each other, even though you're not paying the interest, you have gains that offset the losses and they balance out. That was kind of the general idea of that approach. It has been roundly criticized since then by many of us. So
So we
it's
changed ours
not
in
something that's being
2009.
done.
And so that's why we see that massive spike in the 2009. There was a couple things that we moved in 2009, and that was one of the largest chunks to go from a rolling to a closed amortization. Then we start pulling in the amortization shorter and then decreasing the discount rate. All these things are what's making all that purple happen. Mr. Lederman?
Excuse me, I was simply going to say that some people may be more familiar with the phrase negative amortization, which is essentially the same concept. And as a shorthand, if you, all other things being equal, if you amortize that debt over more than 16 or 17 years, you end up in negative amortization. And so you're not paying the full interest. And so you're adding interest to the principal of the debt each year over a 16 or 17-year amortization schedule.
So let me just
Something like
clarify,
that.
the 16, 17-year period depends on your interest rate, your discount rate, and your assumed payroll growth, with a 6.75% discount rate and the 3% growth, the crossover is more like 21, 22 years.
Okay.
So,
But that's the idea, in case that's more familiar phrase for people. Negative amortization is the concept, if I have that right.
yeah.
Trustee Sun, did you have something to say?
Yeah, since we're talking about negative amortization, we are talking about the plan as a whole, but I just want to divide it out by tiers. So looks like the plan is mostly impacted by tier one. So obviously, when you say the plan had a negative amortization, and it mostly it's mostly really in tier one, right?
Yeah, tier two does not have negative amortization.
Okay.
And just to close the loop, as the chair indicated, in 2009, they went to a 30-year close. So then from that point forward, went 39, 28, 29, 28. So now, this most recent valuation went down to 21 years, and it's the one time where we cross over to pay a little bit more than the actual total interest that was due. Next year will be 20, 19, and so that amount will continue increasing, everything else equal, which we know usually doesn't happen. And that's where we are today.
Anyone else? Let's keep rolling.
The slide focuses on the historical assets and your liability, and that's the top chart. So the bars are your liabilities, the line are your assets, and the percentage above that is your funding ratio. And what you can see is that, yeah, your funding ratio decreased a little bit over time, but now projected in the future, now that you've reached the trade water rate, it's expected, your funding ratio is expected to increase slowly over time as you pay down that UAL. And the bottom graph kind of just corresponds to that. It's showing the bars are actually the unfunded accrued liability, and you can show as you pay it down, eventually in the future your unfunded liability is expected to go down to near to zero.
Mr. Orms?
Quick question.
Go back.
Notice the values are pretty similar, but what is the actuarial value of assets versus the market value?
Do we have that?
So what your actuarial value of assets is it's the smooth value of your assets. So as you have investment gains and losses, you can smooth them. So a particular year, you smooth it over 5 years. And that way it just allows less volatility in the value that you're using. Now the funded ratio is using the actuarial value of assets. And for this plan, you have a 5-year smoothing. So it smooths the gains and losses over 5 years.
Was your question the numbers, or were your question the definition?
My question was about how much smoothing over how many years?
Oh, 5 years.
And a follow-up being, is that an industry norm? Is that something that has changed over time? Is that set in law?
It's definitely very normal to have a 5-year smoothing. It's a very common method to use. Yeah.
It's probably the most common method to use. All right, so what have we learned? And there are probably a lot more lessons than we're highlighting here, but wanted to highlight a few. We think you want to keep a contribution policy where you're contributing at least the tread water amount, so that you could, after an immediate investment loss, it may take a year or two to get up there to adjust, but having contributions be consistently below that it really erodes your funded status over time. And then it makes it difficult to change the contribution level, because you have to make a significant change to the contribution level to get it up and start paying down the unfunded. So in general, that is a significant piece. And that's something, you know, if you look at the differences between police and fire and federated, police and fire did contribute for the most part more than the Treadwater amount. And that's one of the reasons that they're in a better funded position than federated. When we're setting assumptions, the assumptions really go to setting a budget of how much is going to come from contributions and how much from investment earnings, and what are we actually targeting as the amount of money we need to pay these benefits. So it's really useful to be very harsh and realistic on setting those assumptions, and to have a slight conservative bias, because as things play out, we're going to get variations. And some of the assumptions, you're picking a point within kind of a wide distribution. That's probably the biggest issue with the investment returns is you can assume 6.75, but there's going to be a wide dispersion out there of actual investment returns. But that's also true of some of the other assumptions. And so one of the difficulties this fund had was making those shifts in the assumptions, and not just the discount rate, but the others compounding as well, has made it difficult. We talked about the declining interest rates on that chart with the implied risk premium. And that is a very difficult economic environment for plans to navigate. Because we think when interest rates go down, you get good investment returns. You do. But then the market conditions change, and it forces you to change your expected return going forward. And the additional investment returns you get are not nearly as powerful as having to change the discount rate to stay at the same level of risk. So that's a very difficult environment for all pension plans to deal with. And now that, well, now that the Fed's reducing interest rates again, we're not talking about potential increases as much. But when there was discussion of potential increases in interest rates, that's actually something that would kind of reverse that process. And you would see reductions in your assets, but then you could either look at reducing the risks in your investment portfolios or potentially getting higher returns going forward. So that is something to keep in mind and watch. If interest rates continue to go down, that's going to continue to be a very difficult situation for pension plans. And then the other thing, people like to come in and make a change, do pension reform, and say it's fixed. You can't fix these things overnight. It takes a long time. You change the path, but you saw in those projections, it's 20 more years before we expect to reach full funding in this plan, if all of our assumptions are met. Now, if things turn out better than we expect, then we can get there faster. But it takes a long time to get these things back after significant losses. I think other plans also realize that 100% funded should not be viewed as a ceiling. A lot of times when plans got above 100%, they spent money on benefit increases and other things. And so there's a lot more awareness now that 100% if you're 110% funded, that's really providing you a cushion against some bad experience. It doesn't mean you have additional money to spend necessarily. Okay, with that, I'm going to pass it to Stephen here for a little bit.
Hello, everyone. So
Stephen.
we're on slide 13 now. This slide shows, again, the breakdown of contributions for fiscal year and 2020, but we're looking at it by tier now. So for the next few slides, we want to compare the tiers. And you can see on the left side of the left chart that there's this large sort of light yellow piece, which is the city's portion of the UAL in Tier 1. And that pretty much dwarfs everything. So that is based on the amortization methods, that's the amount of UAL being paid by the city. Now there's a piece underneath that is the city's normal cost in the darker yellow, and then the member normal cost in purple. And then we have 0.1 showing there on the side, and that's a very, very small piece. That's some member UAL. Now compare that to Tier 2, where they're sharing roughly 50-50. Well, it is 50-50 of the city normal cost and the member normal cost, and then the UAL is very, very small, 0.4. And again, there's a tiny member piece, but I guess what we want to show here is that that city portion of the UAL is dwarfing everything. And on the right side, we show the funded status, similar to some of the charts from earlier, but we're showing it by tier. So on the left you have Tier 1, and we intentionally left the scale here to show that Tier 2 is just a tiny portion there. And yes, it's 85% funded, but it's a very tiny portion, whereas Tier 1 is 50% funded, and it is the lion's share of the liabilities.
So the right chart has it's the dollars on the y-axis. It's in thousands or in dollar amounts?
It's in thousands.
Thousands.
4 billion, that's the aggregation, right?
Yeah, 4 billion.
It's in police and fire and federated.
No, just federated.
That's just federated.
Yeah, the early slides in the presentation, we did show both because we wanted some perspective on how the two differ. But now we're focusing solely on the federated plan and looking at the two tiers.
Also, this is the bar on the right side is total liability.
Correct.
For the plan.
Just over 4 billion.
Okay. Then, even though this Tier 2 assets and liability are smaller in comparison, can I have a number on that? Well, how much liability we have in Tier 2? What's less level
Yeah,
for
we
Tier?
put that in the appendix. It's a little over 50 million in liability. The unfunded liability for Tier 2 is about 8 million, compared to the unfunded liability for Tier 1 is 2 billion.
So are there any other questions on slide 13?
We can keep going. If Trustee Sun has more, we can come back, for sure.
Okay. So on slide 14, we again look at some projections by tier. Now, on the top slide, or the top chart, we're showing the projected payroll by tier. And you can see that tier 2 is, well, so historically all Tier 1. Tier 2 comes in. So now we're approaching 50% of payroll under Tier 2. That will be crossed in the next couple of years, where over half of the payroll will be tier 2. And, projecting that forward, you can see that the tier 1 payroll drops off pretty significantly, fairly quickly, as new hires come in and people retire. But if you look at the bottom chart, we're showing the projected actuarial liability by tier. And that shows, that's a very different picture. So it's almost entirely tier 1, and you just start to see tier 2, some emerging liability there. And, even out at 2039, you still have, more than 2/3 of the liability is for tier 1. So as all those retirees, there are still, enough retirees around to have a significant liability there. But we wanted to show, as Bill was saying earlier, that these things change very slowly. So that this, the changes that came in with tier 2, these emerge slowly over time, even though the payroll transitions fairly quickly in comparison.
Councilmember Davis.
Thank you. Why is the tier 2 actuarial liability projected to grow at all? So we've set it up.
Well,
I
not
thought we set
unfunded,
it
not
up.
unfunded liability will be
Just
growing
liability
liability,
in
period,
general.
yeah. So naturally it'll
Okay.
grow liability. It's, not to conflate it with an unfunded liability. It's
Okay.
just, this is just a liability that will grow as the nature of the
The
benefits grow.
assets should match.
Okay, thank you, that's helpful.
Yeah, sure.
Before you go. Stephen's talking about the tier 1 versus tier 2, but I wanted to go back to my lessons from the past for just a second on
Blast
the
from the
top
past, yeah.
chart. Because if you look at 2009 to now, the total payroll, we haven't quite got back to the payroll we had in 2009 over the last 10 years. So that's the result of, this city lost revenue, we lost, the number of employees in the plan declined. There was an across-the-board pay cut in 2011, I believe it was. Yeah, that's that significant drop. And at the same time, we were asking for larger and larger contributions. So that combination of things that happened during the recession is very difficult to deal with. So the recovery out of that to build our payroll back up is much slower. Now, all these projections going forward are assuming that we have the same number of active employees in total going forward. Those numbers will move up and down depending on whether we grow the active population or the active population shrinks again.
Yeah, no, that was a good point. Moving on to slide 15. So here we're showing the projected.
So, Bill, just to follow up that last statement, so the underlying assumptions on this chart assume no workforce growth.
Correct.
Thanks.
Correct, a stable active population. And as tier 1 employees retire, they are replaced by tier 2 employees. So on slide 15, we're showing the projected net cash flow by tier. And so net cash flow would be, your contributions coming in versus your benefit payments and expenses going out, as one of the early slides Jackie showed. And when those are negative, it can cause some challenges. So if we look at this by, first let's look at in total. So the green line shows in total that the cash flows are negative, and that's because the tier one portion of the plan is very mature. There are a lot of benefits being paid out and fewer active members, paying in to support that. But if we break it into tier, or we break it out by tier, the tier 2 portion is actually the positive cash flow, because there aren't many members that are retired yet under that tier. Now, if we look down below at the benefit payments, so these are the payments being made to retirees, and I guess also some returns of contribution, that sort of thing. Those have grown, or those are projected to grow, but you don't see much there under tier 2. It just starts to show up, quite a ways out there. And again, even out, 50 years, you can see that it's primarily
Yeah, that's current
Tier 1.
members only.
true. This is current members, so yeah, that's a good point. So that's a good point. As the dark blue drops off, there will be replacement. Yeah, that's right. That was not an open projection.
Seeing frowny eyes, are there questions?
There's an odd discontinuity out in 2038, 2039. Would you care to comment on that?
You're talking on the top chart?
On the top chart, yeah. That has to do with an amortization being paid off, and so contributions go down because we're near fully funded, and so with less contributions coming in, the negative cash flow is worse.
Increases.
So negative cash flow presents some challenges, but it is the objective of a pension plan. We want to put money away now so that we can draw it out of the pension plan later to pay benefits. And so when you're fully funded, you'll have more negative cash flow than when you're poorly funded, because when you're poorly funded, we're going to increase contributions to get you better funded. And so what you're seeing there is we're hitting a point in our payment plan that reduces the contribution.
So I think you've made a couple of comments, Bill, that being in negative cash flow scenario is a challenge or an opportunity for challenges, but it's also the natural state of a closed Tier 1 plan that it would be a negative cash flow. I don't think you discussed what those challenges, how they present us. I don't think it's clearly come across.
So well, and I'm sure we'll get into this on the investment side, because the first challenge of negative cash flow is you have to have liquidity in your fund to pay the cash flow. So when you have positive cash flow, your contributions are coming in, and you use those contributions to pay the benefits, and then you invest the leftover contributions. Here, it's the reverse. You still have contributions coming in, but it's not enough to cover those benefits. So you have to liquidate some investments each month, or I'll let Prabhu talk about the logistics of how it works. But you've got to liquidate some investments or have income come off of investments to fill in the benefit payment requirements. And so that has different implications. And then given volatility in markets, the negative cash flow can present some challenges there. And we note that negative cash flow, the investment returns in the short term have a bigger impact. And so it makes it more challenging to recover from investment losses.
And only because I'm a really simple person, simple-minded that is, that we have our contributions that are coming in from the city are massive, but we also have massive payments as well, paying out our checks to our retirees. That's going to be the case in the investment cycle. If it's hard to get returns, is less likely to have this extra cash from the returns that would be able to pay payments. That's the challenge, right? And so we're not extra.
Yeah, well,
investment returns is not as high as the ability to pay payments, and so we're pulling from the corpus to pay benefits, which is the nature of a pension plan.
Do you want to?
Well, so it's the negative cash flows will become an issue at some point in the future. Right now, we do get city contributions and we make payments, and it's about 1% of the plan. And which is why in our asset allocation, we have an immunized cash flow bucket that actually takes care of 5 years of projected cash flows, especially with police and fire, and less so with federated. In the next 10 years or so, there'll be significant outflows. And that creates, I guess that's what you're referring to, Bill. So that creates significant challenges in terms of asset allocation and how much we need to put aside for liquidity. And that has a bearing on investment returns as well.
Just so that it's understood for the average person, that means that funds that are in liquid investments earn the least return. Thus, the asset allocation as the amount of funds needed to be liquid increases, then we have less in the bucket to seek investment in some potential higher return investment. So I just wanted to make that point. I'm always worried about when we make explanations what the average person is thinking. But of course, if the market is in a downturn, then obviously having the liquid may be helpful assets.
Yeah, to down, I guess that's a little bit irrelevant. I just want to throw some thoughts in everybody's mind is because the aggregate plan and mostly Tier 1 has such a high negative cash flow, so the investment asset allocation has to build certain amount of liquidity into the investment plan. And then if we take Tier 2 assets out of this discussion, Tier 2 doesn't have any negative cash flow. Tier 2 people assets, albeit small at 50 million, we may see net growth for the next 20, 10, 20, 40, 30 years. Do we need to partake? Does that asset need to be participating in the investment plan with so much liquidity built in? I just want to throw this question out to everybody. Think about that.
Okay.
All right, so moving on to slide 16, again, we are showing a breakout by tier, but here we're showing the range of contribution amounts projected out into the future. And again, with the scale, you can see that Tier 1 has the potential for very, significant contributions. And there's also some potential for some significant upside. And what we're showing here are the different percentiles of returns, right? So the baseline, and then the different bars around that are better and lower, or higher and lower returns. But you can see that Tier 2, again, I guess 2 points there. One, that it's a much smaller amount, but secondly, that there's not a ton of variation expected, and less upside too, because you're putting in the normal cost. So I don't know, Jim.
Yeah, let's go back. So just to kind of put a point on that, if you go all the way out to 2033, we're expecting the Tier 1 contribution to be a little over 200 million, right? That's the black line on the 2033. But with the potential variation just in investment returns, it could be down almost to zero or up above 300 million. So there's a huge range that could come just from investment returns. On Tier 2, the range from investment returns is very small. It's less than $20 million variance due to investment returns. Now, Tier 2 can have more variability in the contributions, but it's going to come from having changes in payroll, changes in the number of Tier 2 members, and those sorts of things. But the investment returns are not going to drive a significant change in Tier 2 contribution amounts for the next 15, 20, 30 years as Tier 2 is growing.
Yeah, so maybe the key takeaway is there's a lot of leveraging that potentially happens based on a large pool of assets versus a very small pool of assets. So on slide 17, we're going to switch gears a little bit and talk about some of the characteristics of the different tiers. And we're starting with Tier 1. So, I guess the the first bullet point is that it's 50% funded. And, you know, there's a declining active population. It is closed to new members, and there are large liabilities and large contributions compared to the city's budget. So, you know, this is basically summarizing what we've been seeing here. There is a growing negative cash flow, and the city bears the risk on the UAL. So it's not shared the way Tier 2 is. So gains and losses that emerge, those UAL payments, the city bears that risk. And the discount rate can impact both the city and member contributions. So given those characteristics, on slide 18, we've proposed some objectives. One being contribute as much as the city can afford, and it is, you know, there's a balancing act here. Second bullet point being keep the contributions above the tread water level, meaning at least pay the cost of accruals for the year, the normal cost, and the interest on the unfunded liability, so that the unfunded actuarial liability is not growing. Third bullet point, avoid unaffordable investment losses. You know, as we showed a couple slides back, investments can have a very large impact down the road. And then, as we discussed, maintain liquidity to manage the negative cash flow. And then also, when the funded status improves, consider reducing the risk.
So I think these are largely things we've talked about, and the board has kind of followed these general philosophies the last several years at least. We would love to get the fund, get a better funded status faster. The question is just how much contribution can the city really afford to make, and what are the implications of raising it faster than we are. But we've been kind of moving along this path, I think. And I don't know if
Well, only
Matt or
the missed
others-
header is the proposed objectives. These are objectives that we've been employing for a number of years and getting to basically check the boxes on all these. We've certainly presented to the city that concept in the joint meeting with the retirement boards and the city council on what the advantages of additional contributions. I mean, Councilmember Davis brought that up, that it could be done if they have the capacity in their budget as things are coming along, as a concept of making additional contributions as a way to pay down that principal more timely. So I think the thing I would change is there's a header that's proposed implying that they're not being done now. But they're certainly I'd say all the ones below it are being done, and I think the top bullet is something that's certainly being contemplated at the city council level and their discussions.
Mr. Chair, can I ask a quick question? Can you comment, Bill, on the last bullet point? And let me tell you why I'm asking you to do that. We have maintained this message that we are reducing risk with the asset allocation. And we have been taking that approach for some time now. But your statement says here, when funded status improve. Can you comment on that? Because obviously we have been doing this while the funded status has been decreasing. And so now with the statement considering reducing risk when the funded status improve, I wonder if someone else will take that message or whatever message we have been providing over the last 5 years, either erroneously or misunderstand where we're coming from.
Yeah, so we've done a lot of work on what the variability is of contributions due to investment risk with where we are currently. There's a lot more volatility on that front in the police and fire plan than in this plan. But this plan's 50% funded. That volatility of contribution rate due to investment returns, if we were 100% funded, it'd be twice the volatility, right? So What this is getting at is whatever level you're at now that you're comfortable with, recognize that you're gonna have twice that volatility if you get to 100% funded. And so as those contributions come down, you could consider spending some of those reductions in contributions by reducing risk, as opposed to just fully taking that reduction in contribution. But it's something to look at when we get there, more than right now. You know, I think we've done the analysis now on kind of the levels of risk. There's kind of I guess that's an ongoing analysis, but it's just recognizing that as our funded status improves, we may want to take some more caution, consider taking more caution.
Understood. Thank you.
Okay, so on slide 19, we have the projected Tier 1 contributions. And in a dollar amount, they are increasing over time. The employer contributions are represented by the yellow bar, which is, you know, most of the bar. The member contributions are the amounts at the bottom in the purple color. So we've talked about the Treadwater rate. That is the dark blue line up at the top, and you can see that for 2019 the contribution amount is you know, right at the Treadwater, and so the plan is starting, you know, the contributions are starting to cross that Treadwater mark, and you can see it. So in the coming several years, the bars get above that Treadwater amount, and so the funded status will improve. The UAL will be paid down if everything goes according to assumptions. There's a darker line at the bottom that is the normal cost, and that sort of drops away for Tier 1. You know, we're just looking at Tier 1 here, so that sort of drops away as the closed group, the actives retire. And I guess another item to note is there's a little bit of noise out there, you know, 20 years out, and that again, that's one of that's the large amortization being paid off, so that there's a drop there in contributions. But I guess the overall takeaway is that the contributions are right near the Treadwater amount, so there's not a lot of room to start reducing those contributions short term. And then, you know, the fact that these are so large, you know, that's the balancing act, right? That there's also not a lot of ability probably for the city to absorb higher contributions, given that the city's contribution is nearly 60% of payroll. So I think that the key points here were just the balancing act. You know, you want to be above Treadwater, but you don't want to contribute more than the city can afford. So.
I just want to emphasize one of the things Stephen pointed out is that black line is the normal cost, which means that all of the gold bar above that black line is going to pay the UAL, whether it's the interest or the principal. Everything above that black line is going to pay the UAL. So you can see how dominant that is in the projection. So, well, the level of contributions that are going towards that.
Yeah. And in the slide on the next, well, the next slide, slide 20, we show the components of the UAL. So that was a good segue. You know, the largest being in the center there, that blue 2009 UAL. So that was, well, so that was a large reset that occurred in 2009, and that gets paid off 2039. So you can see there's a drop there, and that's what leads to the discontinuity in a few of the other charts we've seen. And so we have it in the bullet point there. The UAL was fixed at 30 years once upon a time. Well, so that 2009 piece is still going. The assumption changes are amortized currently over 25 years, and the gains and losses and benefit changes are amortized over 20 years. So the combination of those things gets to right about where the tread water, what was it, 22 years we were saying earlier, where the tread water, around where the tread water mark is. But, short term, we're not suggesting any changes here. Out where there's some noise there, maybe in the future some things could be done to sort of smooth that out. But near term, we're not suggesting any changes.
Yeah, so I think police and fire is much further along in in the amortization on this, and so they're looking at some of those bumps that are happening at the end, and we're starting to look at smoothing that piece out for them. We would do that same thing when we get closer to that, but since those bumps don't happen for 15 or 20 years, we'll wait until we get a little closer.
Yeah, and I think the prior discussions we've had on dealing with this amortization is, so this is a large chunk in 2009 that we decided to lump off and say, all right, we're going to pay this off over 30 years, hence this trailing. And essentially hitting one class of taxpayers essentially at one time to pay this whole thing down, something that accrued over a period of probably multiple generations of taxpayers. And so this is where we've talked about how do we deal with this, and at that time it was still kind of early days on it, and I think this is something that that the organization should discuss about how we deal with it, because right now this current generation of taxpayers is paying this whole bucket of this, and then it will get lopped off, which in theory is a great idea, but it's also whaling this selection of taxpayers singularly at it, causing consequences to resources to provide better salaries for existing employees, better, lots of different alternatives for things that could have been when we were resource challenged. And so that was the discussion last time. I still don't know whether we're early days in that, or if there's any further conversation about dealing with the amortization of that clump. And really, to the point I think we left it last time is, it's probably a good fruitful discussion with City Council about how we deal with this. Essentially, you'll, of course, be paying greater interest. The longer you pay it off, you have more interest payments. And so the bucket gets bigger, but then how we spread that to the different taxpayers, to the current payroll, is something that, again, just being made with an open mind that there's, when questions are there any other alternatives to how we're paying these? And the answer is there are, but there's costs to every alternative as well.
Yeah, and I think our issue has been trying to get us up to that treadwater level first. Yeah. But going forward, as we're exceeding that treadwater level, that issue of the generational equity of how much each class of taxpayers, class of workers, because it certainly affects employees as well, in terms of the number of employees. It affects the number of the services that can be provided, and pay levels, certainly. So it's...
Well, that's really the nut of it, because we're a service delivery organization. We don't make widgets, we provide services. And so the more employees we have, the better paid we are. We have better employees to provide services. And so that's the balance that the organization, the bargaining units, and the city are going to have to kind of weigh out, because, again, that's the trade-off.
Right. So I do think that becomes a bigger question as we move forward here. And I'm not sure that anyone really wants to go off the cliff like that and just in 1 year all of a sudden reduce the contribution by $130 million. That's probably not the best way to budget that out. So we may revisit that, but maybe it is how people want to do it. But in other cases, we've found when we get close to that, we reschedule things so that there's a more gradual ramp down of those contributions.
How close? How close do you have to wait to get there?
Well, we're 20 years away. The ones I've really seen looked at it are within 10 years.
10 years, okay. Understood. Thank you.
Tier 2?
All right, so so tier 1 is all about paying off that UAL and how do we get there. Tier 2's completely different, and so we wanted to talk a little bit about tier 2 and how we might approach handling it if it was the only thing. So it's well funded, 85%, but there's just some real quick variations that are going on that switched it to 85%. It's less than $8 million in unfunded liability. So it's really a pretty well-funded tier. It's got a rapidly growing active population, and growth solves a lot of problems and helps deal with a lot of risks. So it really provides stability to that system while we're growing.
For the audience, why is there any unfunded liability in Tier 2?
Well, we've changed the discount rate, for one thing. I think that was the last thing that had an impact.
Okay.
There's also, just when we have new people come in, the measurements of whether they have less than half a year of service or more than half a year of service, when we first recognize them, kind of changes the liabilities. And when we're looking at in small dollar amounts, it doesn't have any impact, but in the early years, it has an impact on what that funded status number is.
Am I wrong to think there was two things I had in my head, and maybe I'm missing it? At first, we had to kind of guess what the contribution rates were as best
That's true,
approximation
too.
similar. And so we sort of had to make a guesstimate because we had no population to model it on. And so you made a guesstimate based on our existing population with some factors. And so we might have been a little wrong on that, but we had no information to make a decision on, number one. And number two, wasn't there a slight modification in the benefit with Measure F?
Yeah, that's
that
what I was
changed it
going to
from
say.
62
I think
to
that
60
was
or
the
whatever
bigger
number was,
piece.
65 to 62, and then that modified the, an increased benefit essentially cost a bit more than those first few years. Those are the two I had in my head. Am I missing something?
And then the reduction in the discount rate.
Yes, the reduction.
those
So
three.
three things. Okay.
And I really think it's the last two that are the most significant.
And also, even though you said the investment return doesn't really have play a big role in the contribution, but I want to say is, if the actual return of the asset underperforms the required rate of return, that difference adds to the alpha liability, right?
It does.
Yeah.
So overall, you saw from the charts Stephen showed, the liabilities and the contributions are relatively small compared to the city and compared to Tier 1. Tier 1 is a large liability compared to the city. We have positive cash flow, and it's growing positive cash flow. As we get more Tier 2 members, we're getting more and more positive cash flow because we're not really paying out much of any benefits yet. But as we said at the beginning, both the city and the members share the risks of paying for the UAL, and any of the changes in assumptions, including the discount rate, will affect both the city and member contributions.
I'm sorry, did I interrupt?
You go ahead.
I'd just like to ask a quick question, and maybe Ms. Parkman from OER can address the issue, unless you know the answer. The 1, 2, 3, 4, the fifth bullet point, city and members both share the risk, paying for any UAL. So first, a question to you. That is not a typical arrangement in public pension plans. I don't know lately with all the changes whether there are other plans that have typical arrangement like that, but it's not typical, so that obviously has an impact. Is that a fair statement?
Yeah, I'd say it's not typical, but we are seeing
More and more these days.
Methods for sharing the risk. It's not always through contributions.
And then the question to me is, part of it is, I'm aware that the city members are both to share the risk. But my understanding is that on the annual basis, there is a ceiling that we can take the members' contribution to.
Yes.
So I guess my question is, how do you handle that delta, that gap, if we have, for example, a sustained 3 to 5 years of bad returns where that gap continue increasing because the gap between the plan sponsor and the employee, because there is a ceiling on how much we can increase the employees on the annual basis? That's the question that I have.
Yeah, so, and you can correct me if I have this wrong off the top of my head, but my recollection is there's a cap to the 1 year change in the UAL rate for members. So if we changed the discount rate down to 4%, that would have a huge impact
That's
on
right.
the normal cost, and all of that would flow through immediately. But just on the UAL rate, there's a cap that it can't change by more than, I believe it's 1/3% in 1 year. And so then the city picks up any difference in that year for what we need for the full UAL contribution. But if you build up that gap, the member contribution, UAL contribution rate is going to go up 1/3% per year until it gets back to the 50-50 range.
Okay, I'm not that bright as you actuaries are. Can you speak to that in dollars?
How about
So the-
percents? So let's say that we had some losses.
Yes.
And it should increase the UAL rate by 1% of pay.
Yes.
What would happen is the first year, we'd increase the member rate by 1/3% of pay.
That's right.
And the city would pick up
Their
2/3
portion plus
their
2/3.
1%. So they'd pick up 1 2/3, and the members would pick up 1/3. The next year, the city would pick up 1 1/3, and the members would pick up 2/3. And then the following year.
I'm sorry, wait. You just said that the members cannot increase by more than 1/3 of 1%.
A total.
Per
of-
year.
A total of
Per
2/3.
year.
A total of 2/3, not an additional 2/3.
Okay.
So they go 1/3, 2/3, 1.
All right. So in dollars figures, if it's a $1 each 1 year, the next year it goes up, it'd be $1.33 versus $1.33 plus the rest is $1.67 by the. See, this is why I wanted the dollar figures. $1.67 by the employer. So right there is $1.33, $1.67. So the next year, in your example, what would be the number?
So it's.
I mean, did I get it right the first year?
So the first year, it's 33 cents for the member and $1.67 for the employer.
That's right.
The second year, it would be 67 cents for the member and $1.33 for the city. And the third year, it'd be $1 for the member and $1 for the city.
Assuming everything is equal.
Assuming all the
Yeah, which is my point, is that is very unlikely. So I was trying to understand what would happen if that gap gets to a point that is hard for the members to catch up to. That's the question.
Yeah, it's, well, one, it's really hard for that to happen right now.
Okay. No, I get it. I know, I get that right now, yes, I understand that. Okay.
Down the road, long term.
20,
that-
30, 40 years from now.
That could become an issue.
All right.
But the result would just be that you would have gradually increasing member contributions.
Okay.
Just following that cap.
And thank you, you are correct. This is not an issue in the next 10, 15 years, most likely. I don't know about after that, but I understood. Okay. So was that a fair explanation? That's your understanding as well?
Yes. Bill's explanation was absolutely how we
Okay.
described it in our framework.
Understood. Thank you.
All right, let's go to the controversial piece. Okay, so, unlike the Tier 1 objectives, which probably didn't need the proposed in front, this probably does need the proposed in front, because we've talked about some of it, but we haven't really developed this, and certainly haven't gone all the way. So our thought is that the objective is we need to maintain a funded status near 100% so that we don't get a large UAL that members have to pay a portion of, because that could be very difficult. So while Tier 2 is young and growing, we put a 10-year amortization in for Tier 2 as opposed to the 20 years for Tier 1. So we're trying to keep that amortization period short so that we stay closer to 100%. And even with that 10-year amortization, it's still difficult to make big swings in the Tier 2 contribution rate. Over time, that's going to change. And then, in theory at least, for Tier 2, you could pursue a relatively aggressive investment strategy. And so that's kind of the question here about whether that's worth pursuing at this point. But where Tier 1 has all that volatility and the negative cash flow, and has some concerns about that, or has issues with the risk because of that volatility, Tier 2 doesn't. So in theory, you could pursue a pretty aggressive investment strategy in the short term. But as Tier 2 matures, that volatility is going to increase. And so you wouldn't want to plan on having the aggressive investment strategy forever. You would need to reduce that investment risk over time. And we probably don't want to have the short amortization period forever either. We'll want to consider lengthening it so that it provides more stability to the contribution rate. And so it's a matter of how and when you want to pull those triggers or make adjustments along those lines.
Do you have a projected projection for when Tier 2 may mature?
It's a long ways out.
How many, 10 years, 20 years, 50 years, 90 years? What
It's going to be 20 or 30 years before you see much. The slide Stephen showed went out just 15 years, showing the volatility as virtually nothing. And so we're going to have to get out probably 25, 30 years before there's significant volatility. And it's going to gradually change over time. It's something that we want to monitor and watch as we go along. But it's going to be a long time before it's a significant effect.
Bill, can you please remind me what is the short amortization period for Tier 2 members? Is it 10?
It's 10 years.
10 years.
So let's go to the next slide. So this is showing, we finally put Tier 2 on its own scale so you could actually see it here. But these are the projected contributions if everything goes according to our assumptions. No growth in total number of active employees. It's just growth in Tier 2 members as they replace retiring Tier 1 members. And so that's where the growth in contributions is largely coming from. And given, you can see there's, from year to year, there's fairly significant percentage growth for the first few years in those contributions. And so that's partly why there's very little variation in the contributions due to investment returns, because they're just getting overwhelmed by the growing size of the regular contributions. And so if you have, part of it is if you had an investment loss, even if it was significant, the next year you have more people to help pay for it, and even more people the following year. And so it's a lot easier to absorb, as opposed to having fewer people and fewer people each year to pay for it. Changes in assumptions, however, can have a more significant impact, because that will directly affect the normal cost instead of the unfunded liability, and that change will move the contribution. So if we were just dealing with Tier 2, one thought here is that we should really use 2 discount rates to help manage this transition while it matures. We'd use a post-retirement discount rate, which essentially tells us how much assets do we need to accumulate by the time someone retires to pay their benefits in retirement. And then we'd use a separate pre-retirement discount rate that we're using to see how fast contributions accumulate to that asset target by retirement. And so we could use a lower discount rate for the post-retirement to anticipate a more conservative investment strategy in retirement, and then a more aggressive or a higher discount rate pre-retirement. And so the basic idea of this approach is it puts you on a path to try and accumulate more assets by the time someone retires, so that at that point, then you could invest those assets more conservatively to pay out, so that there wasn't the volatility in the UAL. Does that make sense?
I believe so. Mr. Lawrence?
How common is this dual discount rate setup for pension plans?
It's not common today. It used to be something that was done a long time ago, but I think things moved to simplifying to a single discount rate, particularly, I think back in the 80s and 90s when, the more conservative rate wasn't really that much different than the more aggressive rate. So it's a theoretical structure that I think makes a lot of sense, but it is not something that's commonly in practice.
Bill, are you referring, this slide is suggesting that the 2 discounts apply to the entire population, or are you talking about the Tier 1 or Tier 2?
This is just Tier 2.
Okay.
We're just talking Tier 2. And this is intended to kind of facilitate a transition as Tier 2 matures to automatically move to a more conservative structure as it matures. Because you start with everyone active and you have an effective higher discount rate, but as people retire, the effective plan-wide discount rate would automatically go down and become more conservative. And the idea would be that you would mirror that in some way in your investment policy, and we'll talk about some of that. Right now, we're at a really high theoretical level on that.
To help with some of the concept, we're at 6.75 right now with our discount rate. What roughly?
Let me get to the
what
examples
roughly?
here. Because, one of the places this could go, if you're interested, is we could pursue a whole study about what those discount rates should be. But to think of it conceptually, the post-retirement discount rate would be that expected return on the assets that we would use when they're in retirement. And so the most conservative approach there would be to have that be a matching bond portfolio that would match the benefit payments. And we're doing that in terms of like the next 5 years of benefit payments now. But this would be, conceptually at least, when someone retires, their portfolio would be invested in a matching bond portfolio that would match the expected benefit payments for them. Now, that's the pure theoretical. In practice, I think you'd deviate from that. You could just match the duration of the bond portfolio so that you're not too focused on it. You can vary the credit quality so that you could get a higher return. And you can include non-matching investments. You could have some equities. The idea would just be to be more conservative and to assess what level of risk you could take on for retirees so that the investment gains and losses on retirees aren't leveraged on the active members. Because right now, the active members would have to pay for any gains or losses on retiree benefits. We don't have any retiree benefits, so that's not a big deal. But if we got to the point where we have a huge retiree benefit population and we're still invested pretty aggressively, that's going to have a huge leveraging effect on the active members. And so the idea here would be that you would decide how much of risk that you could afford on the retirees and then build that into your plan so that it gradually changes over time. And I've got an example here to run through and show you, but before I do that, pre-retirement, the gains and losses are less significant. You start out with $0 for a new hire, and then you're building it through their career. And they have positive cash flow. So you could, in theory, have a more aggressive investment policy for them to accumulate to that target asset. So let's do the example here. So let's just say we are funding for a benefit of $5,000 per month payable at age 65 with a 1.5% COLA. So then let's start in the first column. We have our current structure where we use 6.75%, both post and pre-retirement. Middle column, we're saying this is the 2 discount rate approach. What if we used a post-retirement discount rate of 4.5 and a pre-retirement of 7.5? Or in the last column is closer to what financial economists would have been suggesting, is that we should use something more like 4.5 for everything. So what that means is for the $5,000 per month benefit payable at age 65, if we have a post-retirement discount rate of 6.75%, we would need $755,000 in the bank at age 65 to pay that benefit. At 4.5, we need $941,000. And so both of the 2 right columns are targeting $941,000 by age 65. Now, how do we accumulate that? Well, we accumulate that with contributions that increase with pay. We try and do it as a level percent of pay. And so if those contributions are accumulating or earning 6.75% interest while you're active, we'd need $2,643 per year for someone starting at age 25, because they're going to pay for 40 years, and $5,872 for someone 35, and $14,532 for someone at age 45, because we only have 20 years to accumulate. In the far right column, those amounts are not quite double, but except for the 25-year-old, because we're only accumulating at 4.5. But with the 2 discount rates, you end up in between, because you're trying to target that higher amount of $941,000, but you're expecting to earn 7.5 instead of 4.5. And so it ends up being more than the current, but a lot less than if we were trying to be conservative the entire time. We just ran these on the 2018 valuation to see what the impact on the normal cost rate would be. And so the current normal cost rate is 16.1%, which is split evenly between members and city. If you did 4.5 and 7.5, it would increase to 19.6. And if you did the straight 4.5, it would increase to 27.1. So we're not saying here that 4.5 and 7.5 are the right numbers for the assumptions, but and you could certainly phase into this type of adjustment and not do it all at once. But conceptually, it helps set the plan up for a transition to where it needs to be over time, but it does require more contributions now. So using that 2 discount rate approach, it will automatically and gradually shift the plan to be more conservative as it matures. Problem is the contribution impact is realized now, but the improvement in the generational equity, you don't get those advantages until 20 or 30 years from now. That stability of the contribution rates, they're going to be stable now. And so you're not really getting the benefit of that until much later. It also adds some administrative complexity, and it takes you out of the norm because it's not what other systems are doing. If we continue on the single discount rate approach, it really requires us to be vigilant and make the manual adjustments as the plan matures when they need to be made. And each time we make an adjustment, it's going to affect contributions at that time and if we wait till it's mature, when you make the adjustment, you will not only adjust the normal cost rate, you'll create a UAL payment that has to be paid as well. And if we don't make those adjustments, we could get into the situation where we have very volatile employee contributions. But as we showed, there's a 20, 30-year run out before we get to times when that maturity really has an impact. And so the lower contributions now for a substantial period, make the single discount rate approach fairly attractive. So going back to our general approaches, we could just continue with the single discount rate approach for now, keeping this in mind and thinking about the adjustments that need to be made. We could switch now to a 2 discount rate approach, perhaps phasing in so we didn't jump all the way to something like 4.5. We could kind of gradually move to a more conservative post-retirement discount rate. We would need to do some analysis about what that post-retirement discount rate should be, how we wanted to track it, how it should change when interest rates change or not change. So we're still dealing with it at a fairly theoretical level now. There'd be a lot more work to be done to nail down specifics if that's what the board is interested in. We could also just decide, okay, this is something we want to look at as the Tier 1 UAL is paid off. And part of that argument goes back to the chair's point about the generational equity and the impact on the current generation, which includes both Tier 1 and Tier 2 members, of paying off the Tier 1 UAL. And that in and of itself is imposing a burden on everyone. And so maybe we should plan to wait for that burden to lighten before we switch to a 2 discount rate type of approach. That, if we wanted to look at that, we could look at defining some triggers that would get us to move in that direction, or we could put it on the shelf for a period of time.
Any questions, comments? Mr. Horowitz, grabbing the mic.
Yes, thank you. So if I understand things correctly, and that is certainly not a foregone conclusion, we have 2 issues, main issues facing us, whether to separate the pool of assets into 2 separate pools of assets for Tier 1 and for Tier 2, and then separately, whether to adopt a 2 discount rate approach in the pool of assets for Tier 2. Is that fundamentally correct?
So I think the mechanics of 2 different pools of assets, we haven't really gone through the analysis of that here. We are saying that there could be a structure where Tier 2 has different investments, but if you follow the 2 discount rate approach, it's not clear that there's a significant change right now in the investment strategy. Once you get a bunch of retirees, there would be. And whether that requires you to actually physically separate the assets or not is a whole different question that we would want to go through. Versus right now, all the assets are pooled together, but we account for them separately and track them separately so that we have different values for Tier 1 and Tier 2.
But we don't invest separately.
We don't invest separately. I think you'd have to look at the advantages of 2 separate pools versus something that I would think of as akin to a master trust type of arrangement where you have 1 pool, but you assign shares to different investment strategies for the different tiers. But that gets to a whole nother level of detail before we, there are higher level decisions before we need to get into figuring out what would be the best approach there.
Bill, the 2-tier, thank you. The 2-tier approach, if I understand it, Tier 1 is completely insulated from the Tier 2 changes that are we're
Yeah, we
looking
would
at
not
right
be
now.
making these changes. The 2 discount rate approach, we're not suggesting that for Tier 1.
But Tier 1 employees and the city contribution towards Tier 1, those would not be changed as a result of these?
No.
Just be localized to Tier 2?
It would just be Tier 2.
The audience has been provocatively quiet.
Yes.
I know you're uber eager to dive into the actuarial science fund that we get to deal with. Are there questions or comments or thoughts on any of the things that have been talked about here? I'm eager to hear your thoughts on it. I also understand that sometimes this gets pretty meaty and don't really know how to word our questions. And so if there's thoughts or questions, I'd welcome them. And I know the board wants to hear from you if you have thoughts or questions or you want us to be thinking about particular things.
And maybe while that's happening, Bill, could you maybe just give us some ideas about the triggers that you're talking about? That's kind of intriguing to me.
So we could do triggers based on funded status or contribution levels, for example. So that the idea would be that as the city's burden on Tier 1 eases, that we would use some of that savings to transition Tier 2 to this other approach. And so I guess the easiest thing would be to tie it to either contribution levels for Tier 1 or funded status for Tier 1.
And it could be that,
95%, 90% or something like that. We could trigger
Right.
things down as we get more of the, as that curve on one of the slides goes, as we get paying more of the principal on the unfunded liability, as that burden goes down.
Right,
And essentially spread out that longer lump past
the bumps that we were
2038.
talking about,
Yeah.
10 years out, or 10 years before the amortization period closes, that might be.
Yeah, so if you look at this slide is the projection of Tier 1 contributions. So this assumes all assumptions are met. And if we're doing that, we probably wouldn't be triggering, well, those numbers, while they're going up, would become a smaller and smaller portion of the city's budget, hopefully. We didn't have do we have, actually, go to the model, we can show this same thing. I think it's helpful to look at this as a, choose Tier 1. And then change this to percent. Okay, so now the bottom graph up here is showing the Tier 1 contribution as a percent of total payroll. So not just Tier 1 payroll, but total Tier 1 plus Tier 2 payroll. And the idea is that gives you a sense of the relative burden on the city, because presumably the city's going to grow in concert with payroll growing. And so this may be the way that we want to tie it is over time, we're expecting that Tier 1 liability to be less and less significant for the city, even as the dollar amounts go up. And then at the end, certainly when the dollar amounts drop, it becomes far less significant. And so we could tie it into something like that.
Just make sure the mic's on. We haven't used it yet today, I don't think. There you go.
Hi, I'm Matt. I'm Mason with IFPDE Local 21. So watching these always makes me wish I paid attention more to my statistics classes in college. But I just want to make sure I sort of understand that today the presentation is not about the mechanics or what the legal or actual mechanics would be to separate the plans or the benefits or costs of this, but to sort of do an analysis of the two plans separately to understand sort of the potential investments moving forward, and also look at this second having two rates associated with Tier 2 potentially in the future.
Yeah, so it's really looking at a high level at the ways that we might manage the costs going forward. And really, the only significant change we're looking at potentially is, do we want to do something different on Tier 2 to prevent it in the long run from becoming too volatile? And do we want to incur the costs of that change now? Or do we want to keep that as something to look at down the road?
Okay, thank you.
Please.
Bill, I'm sure you're going to love this question, but if I understood you correctly, again, this is very high level. It is certainly helpful for the board and stakeholders to understand the implications. But if I'm just struggling to understand if there's a time where this become more of an issue that we need to deal with, how far down the road that is. do you have a sense of what are we talking about? Just for the average person, are we talking about 5 years from now, 15, 25? What's your thought on that?
Well, so assuming the economic environment's the same as it is today, the sooner you make the change, the less painful it is when we're only looking at the Tier 2 contribution. The longer you wait, the bigger the adjustment on the Tier 2 contribution you're potentially looking at making. And there's no like point in time when you should pull the trigger. But that's why we raised the question about tying it to how Tier 1 is paid off, because there are offsetting effects, even though they're not necessarily directly, because Tier 2 members are going to make an actual contribution. It's going to affect their actual contributions when you make the change.
Well, and I think if you just look at your chart and peg it like 2027, you see areas where there's potential for even, I mean, as things even out, and keeping that flat as a percent over time, that gradually, again, it's fairly tangential and not really meaningful in the next 8 years or so, but after that, maybe that's when it increases. But even if, one of the things we did in 2009 was to realize that this lump, when we were dealing with this rolling amortization stuff that was sort of maddening, how are we going to pay for this? Initially, they wanted to lump that thing down to 20 years, and that nut was sort of insane as to what the costs would be for something that had been rolling around, no pun intended, for quite a while. And so we spread that to 30 years, but potentially this is something, if we decided it was a 1% increase in contribution, we could do this in 5% increments, not 5% overall, but 5% of that 1%, so that over 10 years you would get, or 20 years you would get to a place where you'd absorb it all, and get to a place over time where in a place then so there's not a surge of impact to either the employer or the employee, that you could gradually work your way into it. So, because right now there's been some impacts in the last few years with the modification and benefit, or some of the other slight changes that we've made in the discount rate. I think we have to be thoughtful in that and spread that out over 10 to 15 to 20 years so that it's more absorbable, and also then provides that security on both ends. And not that that's necessarily a bargainable discussion, that we should kick to the bargain, but I think we should certainly engage that this is our intention of why we're doing this. I think once you do that and have that conversation, I think they'd appreciate both the intentionality of where you're going, but also the pace in which you're making those decisions. Because then certainly you could pull back if something drastic happens in the markets or in the employment schemes going on, or you could accelerate if need be. But that way you'd have some kind of, since it's not an urgent, we got to do this in the next 5 years, we don't have to pound on it, but it certainly could be putting ourselves in a trajectory that's more absorbable across both sides. But do it in a big open discussion so people can understand the impacts and why we're doing it, and see if, because really they're the ones paying for it. What makes best sense to them?
Yeah, I agree. I think that's a really prudent approach, not to put off the discussion for 10 years, but to have the discussion now and talk about how can we get there. And I really like the idea of phasing it in. I think that's good for the members, and as we can see, it'll be good for the city as well. And just knowing in advance what's going to happen, as opposed to the decision that had to get made in 2009, was pretty jarring. And we're still 10 years later dealing with those impacts.
Yeah, we still got stink eye from the budget director on those things when he has to, as he sits in the audience. Gradual is good for everybody, so especially if we can figure out a plan forward. Again, then we make these decisions as to how we deal with the assets over time as well. Because again, then when we get into our next discussion about what asset conversation and investment plan we need around these, how do we then isolate, and is it best to have it in two wholly separate buckets? Mr. Polani's pretty smart. I'm sure we can find ways to, what are the most prudent ways to deal with the assets themselves? And I don't think it's an urgent, again, presupposing. It doesn't sound like it's an urgency have to be decided this moment, but certainly we should be putting ourselves, and it's great to be having these conversations now when we don't have to knee-jerk reaction on these conversations. Ms. Sun, did you?
Yeah, I have a couple questions. One is why in a suggestion slides, why do we always pack that the tier 2 decision to the tier 1 pay downs? I thought that the assets and liability are accounted separately in your actuary. Why is the package exist? I don't understand. Why do we have to wait until tier 1 pay down to trigger some actions? Tier 1 may look another 20 years to get paid down, and God knows, I don't know if the 20 years is going to get paid down. And the second one is, if we continue manage all the assets in a commingled pool, what's the best course of action for us to do that? I just feel if we do that, it seems to be but quite a bit of confusion. Because I asked a question earlier, the aggregated plan has such a high demand for liquidity, and then the current asset allocation for the investment policy has quite a bit of liquidity built in. While if we look at tier 2 asset itself, it doesn't need that kind of liquidity. Shouldn't be better off have the assets managed separate, slight differently? Is a separate pool make it cleaner? Does a separate pool makes it cleaner? So I'm just.
Well, I'm going to pause on the assets themselves until we get the Makita discussion.
Okay.
So we'll certainly keep that and have a fruitful discussion there. And the first one was,
Why do we have to peg on tier
why
1
do we
pay
peg
down?
on tier 1? I haven't heard from Bill that we have to. Is as an idea we could, so that the city's contribution isn't, so essentially the city's contribution is stable. And as the city's contribution will dwindle down as a % of overall payroll, perhaps that's how you use, there's a capacity in city payroll that could be used to then put towards additional tier 2 contributions. So
Well, the
use it's an idea, it's not
It's
a.
it
not
is
the
an,
only.
you don't have to. It's an idea, and I think there's that aspect. There's the other question, though, of how much burden is that tier 1 UAL payment having on the number of tier 2 employees we have and the pay levels within the city? Because it's certainly a large impact to the budget. And if you think it has an impact on those things, then it may make sense generationally to wait and gradually address this as that burden goes down. In effect, we're saying tier 2 members, although they're not directly paying for the tier 1 UAL, the tier 1 UAL has an overall impact on the city that affects both tier 1 and tier 2 employees.
Yes, in a way, but I
But
thought.
that's just a philosophical thing to think about and how you want to play it, because there is no direct connection. You're right. There is no direct connection, and so you could argue, no, we want to do it right now, which is why there
Well,
are both options on the table.
I'm trying to figure out what's the relationship, because I know the city has a huge burden on the tier 1 non-funded liability. I thought maybe it's starting from last fiscal year, the city changed the presentation on the unfunded liability payment, and then it's not dialed due to each active employee, right? It's just the unfunded liability contribution by the city is let's say 300 million. City just pays for it, 300 million. It doesn't really divide that 300 million per employee, does it? I'm not so sure about that one. I don't think
Oh,
that's.
you're talking about as an overhead unit cost on tier 1 versus tier 2. So they're paying it as a dollar amount as opposed to a % of pay on
Yeah, I don't
individuals.
think it's a percentage pay anymore. It's just a
That's
dollar
correct.
amount. Yeah.
No, it's not, and it's not, well, I don't know how the city ties it to individual employees, and I don't think we're going there. We're just saying you could take the viewpoint that if the city didn't have to make that $137 million payment, that it would affect other things in the city's budget, including being able to provide more services and presumably pay people more as well. Now, whether that would actually happen or not, I don't know, but there's $137 million on the table here that if the city didn't have to pay, would go somewhere else in their budget.
Yeah.
So I would propose, I think the idea is interesting and merits some more investigation and putting some numbers behind what things might look like, and having another discussion in, say, like December or so you have a couple months to put some things together. And having another 30 or 45-minute discussion again at the board meeting, and just kind of what do these things do? What is this, again, just a more detailed discussion on what it might look like. And then we can see if there's actions that need to get taken. Because again, this is very squishy, and I'm much more, show me what actually means in numbers, and you're using some hypothetical things. Let's look at some actual numbers to see what those costs are and what it would look like, and a potential couple phasing opportunities, and a potential couple triggers that might be interesting. To take advantage of, again, getting more assets aligned to those Tier 2 members when they're ready to retire, and then securing them so that they have a greater chance of less volatility. I think it's interesting, and that's why I'd like to explore it a little bit more, and I'd like you to do more studying on it and come back with some more detailed ideas in, like, say, December, so you have a couple months before we get into all the actuarial stuff fun for the next evaluation.
Well, we'll be,
I know, you get.
December, we'll be hopefully presenting the valuation.
Well, then you'll already be here, so it's perfect.
Well, and so we can build it on the 2019 numbers instead of 2018.
Sure. Do you agree, disagree? What are your thoughts?
Well, can I just add?
Yeah.
Well, first, thank you for the overall analysis. And if I understood, the conversation was really meant to be really brainstorming
Yeah.
and very loose, so there wasn't any conditional action per se, at least from my perspective. That wasn't me, I promise. The question, or maybe the comment I had around the Tier 2 discussion is it the case that we're trying to solve for generational equity? Is that so I'm trying to reframe, like, what is the thing that we're trying to solve for, or what is the benefit that we're trying to create for the employees? And I heard generational equity at the total plan level, Tier 1 and Tier 2.
Yeah, I think.
Is that fair? I mean, I might be going down the wrong line as well. It's very.
No, I think it is a fair way to think about it. And, so there is a generational equity aspect to it. If you're just looking at Tier 2, and the idea is when the plan gets mature, you would want the retiree portion of the portfolio invested more conservatively. The generational equity argument is, well, those Tier 2 employees should have contributed to the asset level needed to do that. And so that's what this is proposing, is that they contribute to it so that we have a plan so that when we get to that point, we have the assets to do that, to invest their retiree benefits more conservatively.
Okay.
And so that is the argument. It gets mixed in then with the overall plan and the
I wanted to set that
generational
aside.
equity
Like, if I was a
aspects of
retiree,
the.
how would I think
yeah.
this is actually going to benefit
Yeah.
me? It feels akin to, and again, I'm even making a roundabout analogy, is like to target date type of funds, right? You simply want the risk to roll off as you're going down the path.
Right.
So I
And
just
I-
wanted to
I
make
think
sure that
the-
that was clear as to why we, like, I know there's all these elements of the details, but I wanted to set that aside because we are talking at a higher level principle of what form, what structure. And I also probably went down the line, is this about demarcation of Tier 1 and Tier 2 because of their very different profiles?
Yep. I think the initial, the reason for the discussion at the highest level is, let's set up Tier 2 for maximal success.
Yes.
And that's really, and then.
That's a fair way to frame it.
And that's really, I think, what does that mean? It means looking at potential asset plans, looking at potential policy plans, looking at actuarial plans around those, to set them up for maximal success.
Yep, thanks.
Mr. Levy?
Been tough to stay quiet this long, but I do, since we are in a retreat, I want to make a point about generational equity. Nice concept, has absolutely nothing to do with your fiduciary responsibilities in stewarding a pension fund. There is no fiduciary responsibility that includes generational equity. It's a nice idea. It's a good theory. All other things being equal, it would be nice to have each generation of members carry their own burden, and the city for the period that services are rendered by the employees, to have that fully paid for, both compensation is an issue for public employees of current compensation and deferred compensation. And it would be nice for each generation of employees, while they're working, to have their current compensation paid to them and have enough money put away to earn enough so that when they retire, the next generation isn't paying for it. We gambled with Tier 1. I don't mean that in any pejorative sense. We gambled with the funding of Tier 1 and lost the gamble so far. We're 50% funded on Tier 1, essentially. When I say gambled, we made projections of mortality, we made projections about what the markets would return, and we came up short. To me, the goal here for the board to consider are mechanisms by which we don't repeat that for Tier 2. We have the opportunity for Tier 2 to do something about the funding today so that we never have to go through what we've had to go through with Tier 1 and the underfunding. Our obligation as a board is to pay the benefits when they come due. We take into account the city's ability to pay, we take into account the members, but for the first time, the members are going to be sharing in that unfunded liability. That's never happened before. So the real question for me as your fiduciary counsel that I'd like to see the board address, not only this idea of, changing the amortization, but the whole idea of continuing to make funding decisions based on future projections, when history has shown us that the projections have never overstated performance, they've always understated. And so we're left with a Tier 1 burden on the city that impacts it in ways that we would like to avoid, I think, for Tier 2, and not repeat the process that we used in the past, whether it's an actuarial process or investment projecting capital markets process. We've come up extremely short on Tier 1, and that's what we're dealing with today. We need to find mechanisms to not repeat that again for Tier 2 if we can. And maybe we can't. It's still a defined benefit plan. And I would say, Mr. Chairman, in terms of going forward, these ideas are worth exploring. Certainly, I'd like to keep the table open for the introduction of some other funding ideas as well as we go forward with talking about how can we, if we can, insulate Tier 2 from the risks that have come to roost regarding the funding of Tier 1. So, thank you.
Comment or questions on any of this? All right, I'm going to give you a mercy break for about 5 minutes. We'll take a recess before we shift decks and move on to the next presentation. So thank you. 5 minutes recess. Back, we're going down to item 2. This is the discussion on capital market expectations and potential impacts on plan funding status, including existing or new policies, principles that would be employed in responding to a significant change in funding status.
Good morning. Our goal is not to go through necessarily every single slide, but to hit the high points and hopefully allow for more discussion and questions. So the point of this presentation is to talk about what the most appropriate asset allocation is. A secondary concern is, do you want to have 2 separate asset allocations if you break out the Tier 1 and Tier 2? That would largely come from an actuarial decision. We, as your investment consultant, think we can structure the most appropriate, along with staff, risk-adjusted returning portfolio for whatever your target is. And we can also talk about some of the challenges that might come if you do have the 2 pools of assets from the investment side as well. And we also wanted to provide some more information that will allow board members to respond to any questions that you get from stakeholders in the plans. So we wanted to review the history of the asset allocation. Asset allocation is the primary determinant of your investment return. The managers that staff and that Makita has assisted in selecting, if you look at your reports, have actually done quite well within their asset classes, within their peer groups. The majority of the asset managers in your investments have outperformed their peer groups since you hired them. So the individual strategies doing quite well. The fact that there are asset classes that have been more out of favor, like, say, hedge funds, there was a large commodities allocation for a long time, have not performed anywhere near U.S. equity returns, has been the primary determinant of the peer relative returns in the federated plan. So I think this slide is really interesting because it looks at the pretty large shifts that have taken place in asset allocation since Makita began working with the federated plan back in 2009. So you can see on the left, when we came on board, we worked with the staff at the time to develop an asset allocation. And you can see in this first column, it was about half global equity, 20% fixed income, and 31% in alternatives. Then sort of 2 CIOs ago, there was a major shift, and you see this in the second column, to 20% in real assets, primarily commodities, and 25% in absolute return, which is hedge funds. Similar to a shift where you say increase fixed income and you can sort of push a button and trade tomorrow and get into a fixed income index fund, going up to 25% in hedge funds takes a long time. A separate consultant was hired. These are funds that aren't very liquid. Typically it takes 6 months to get out. There might still be a sub piece after that. And it also took a long time to research what funds were going to be hired and how that was all going to work. So commensurate with that, other asset classes that have returned well since then, like, say, private markets, were sort of put on the back burner for a while, and there wasn't really investment made in, say, private real estate and private equity during the years that this hedge fund allocation was being built up. Another thing I wanted to mention is that Makita Investment Group's expectations for returns for these real assets and hedge funds were never above the 6.75% level. At the time, the staff did their own study where they came up with their own capital market assumptions that assumed a higher rate of return for hedge funds because they assumed a lot of manager alpha. So I think there's been some discussion around we haven't hit our projections for investment return. A lot of that has been implementation related rather than the board setting an asset allocation that we didn't believe would be hit and that we haven't lived up to. Let's see. So then we moved in August 2014 under the next last CIO, moderated that hedge fund exposure a little bit, moderated the real assets a bit, and diversified it from just commodities. And then in October 2017, we moderated it even more. So now we don't have the column for the current, which we'll talk about later, but we've moved back sort of to what we had in 2010 in some ways, with a little bit more equity, a little bit more basic fixed income, less commodities and hedge funds. So I think, we were asked to talk about sort of lessons learned with this presentation. And one of the big ones has just been that these big shifts in asset allocation haven't sort of allowed us to hit our projected investment returns over time because it takes a long time to build and then sort of unwind, especially hedge funds. So looking at just some peer practices we wanted to talk about briefly.
So shifting over to what peers have been doing in the space, that starts on page 4. and trying to get a better understanding of what US-based public pension plans were doing asset allocation-wise. Makita Investment Group partnered with NASRA at the end of last year to conduct a survey in which 39 plans responded of various sizes. You'll see there depicted in the graph, representing assets from $1.5 billion all the way up to $352 billion. So the results of that peer review were quite interesting. Noted on page 5, you'll see that 43% of US-based plans in that survey noted that they review asset allocation every 4 to 5 years. 30% of those plans note that they review every year. And then shifting to page 6, we'll note that it's one thing to talk about asset allocation. It's another thing to implement new asset allocation. So on page 6, we note the frequency of changes in which 45% of plans make changes every 4 to 5 years, and roughly 18% of plans make changes every year. That brings us to where we are kind of in the marketplace today on page 7. NASRA also surveyed 127 public plans, and we'll note that the median investment return assumption is 7.25%. We'll note there has been a downward trend in investment return assumptions over the past 20 years, which represents much of what Chiron had touched base with on their implied risk premium slide. And interest rates have decreased substantially, and the ability to hit high assumed rates of return have decreased with certainty. That brings us to page 8, which kind of highlights the secular decline in investment returns that we're seeing. We'll note that in the 80s, it was a near certainty for pension plans to hit a 7.5% return. You'll see in 1980, 1985, there's a 99% chance and 98% chance of plans obtaining a return of 7.5%. Here in 2019, the investment landscape is very different. Interest rates have decreased substantially. Expected equity returns have decreased substantially as well. And the probability of earning 7.5% is down to roughly 32%. Page 9 represents several asset classes over the past 10 years as opposed to the past 35 or so years that we saw on the chart before. This compares asset class returns from 2009 to 2019, where you could see that in generally every asset class, you're obtaining less return for either the same or more amount of risk, with expected return designated there on the left side of the page and standard deviation measuring risk on the bottom of the page.
So those slides are sort of designed to show that, asset allocation has shifted more than I think peers have shifted their asset allocations during that time. This plan has been on the front lines of reducing the discount rate. That said, one of the reasons that you have the low funded status is because your assumed return is lower. That doesn't mean that's a bad thing to have moved down, but just so that everyone's aware of that dynamic. If you did have the 7.25% expected return, like peer plans, then your funded status would improve. So we then get into some analysis on the current portfolio. As everyone knows, we cannot predict investment returns. We don't know what the market's going to do. We can look at the historical market environment and look at different things that are happening in the current market environment to try to develop an expected return for each asset class, a risk or standard deviation level for each asset class, and then a correlation to show how those asset classes will move together. So mean variance optimization is the basis for how we project investment returns. But that's not the only thing we look at. We also look at stress testing, different historical scenario analysis, and different proprietary analysis to try to look at differences between portfolios. So we get into portfolios, your current portfolio, and some other potential portfolios that you could consider, all of which take a bit more risk and have a bit higher expected return. This is something we've talked about with your investment committee already, and that we don't expect anyone to take action on. We know there's no action items today, but wanted to talk about how the portfolio might look in different market environments or with a total expected return if you were to shift your assets a bit. So in the left two columns on the slide, you can see the current allocation. So the current allocation has 25% in cash equivalents. You can see that halfway down the page under low beta. One of the things that we believe is already within the current adopted asset allocation, but we wanted to talk about with the board, is to potentially move 20% of what's in cash now to short-term investment grade bonds, which would modestly improve the expected return, would also leave the standard deviation the same. You'll see at the bottom here, we're showing our expected return. These are average annual expected returns for 20 years in the top line, for 10 years in the second line, and then our risk level. So ideally, you want to try to get the highest return you can for a lower level of risk. But of course, the sort of correlation between risk and return is that the more return you want, the more risk you have to take to get there. We also show the VERIS standard deviation. So VERIS is your risk consultant. And the policy in the investment policy statement right now uses VERIS's standard deviation numbers. So every consulting firm develops their own expectations for expected return and standard deviation. None of our numbers are going to be exactly right. They all use different sources. The main thing to look at here with the standard deviation numbers is just relative differences. So it doesn't matter too much if it's 9.2 and 11.6. What matters more is, do you adopt an asset allocation, how that goes up over time? Because one thing that we've experienced recently is nobody is hitting the standard deviation expectations that we put in place. Markets have been, despite perhaps what you see in the financial news, remarkably not volatile over the past several years. So most folks are experiencing a standard deviation that is below what anyone is projecting. Then in the last line, we show the probability of achieving your discount rate of 6.75%. In terms of, something we talk about with boards is what's the relationship between the discount rate that you set with the actuary and what you target on the investment side. Every board looks at that differently. There's no sort of requirement that says you must adopt a portfolio that gets you your discount rate or you must adopt one that's higher. In general, when we work with boards, folks generally want at least a 50% probability of hitting the discount rate that the actuary has come up with and that you've adopted. In some cases in the past, when we've done work with prior staffs and the prior board here, the staff decided, we would recommend an asset allocation that actually has a lower than expected return, a lower expected return than your discount rate, because either we expect that we'll be moving the discount rate down in the future, or we work with plans that have an 8.5% discount rate, and they say, that's not really reasonable, so we're only going to adopt an asset allocation that's expected to get 8% or whatnot. So there's that relationship between the discount rate and what asset allocation, what expected return you adopt is not set in stone. Every board looks at it differently, but generally you want to have a higher probability of hitting that discount rate than lower. One thing that Chiron talked about and that was discussed before is the immunized cash flows. So we had talked about needing more liquidity to pay benefit payments as your plan changes in composition. So that's under cash equivalents. You can see the cash equivalents number never drops below 5, because 5 is what's expected to pay the next 5 years of benefits. And that number would be expected likely to grow over time as those benefit payments increase. We talked about liquidity, where you get income and how you might need more liquid assets as the plan composition changes over time. Different folks have approached that differently. Many people have said we need more liquidity, let's do more in bonds, let's do more in cash. Some people, like one of the San Francisco plans, have said we have a really highly mature private markets portfolio that distributes cash every year, because these are 10-year typically partnerships in private markets and private equity. And so we expect that the distributions from those funds will actually provide us more liquidity over time. So there are different approaches to how you shift your plan to being more liquid. You'll also see most of these alternative allocations reduce hedge funds, increase equity, and also typically leave this sort of other allocations to core private real estate and private markets and that sort of thing the same. One thing I wanted to talk about around the discussion of Tier 1 versus Tier 2 and breaking those assets out, we have a little bit of a case study in the healthcare plan that you already run, which has about 150 million in assets, in terms of how would you structure a plan that has a lower asset base. Some of the challenges from an investment perspective with having a lower asset base is you typically pay higher fees. And you also can't really go into a lot of the illiquid partnerships. You know, you couldn't be doing a lot of the private equity, the private debt, things like that, because a low asset base doesn't allow you to get appropriate diversification. But if we looked at the healthcare plan, it has invested a lot like the pension plan, but used more, say, passive index funds and more sort of straight exposure to the market, which has been a little bit more volatile. It has returned a little bit better in different market environments, like when equities are running up. So it's very reasonable for us to structure two different plans. We've already done that. You know, we consult the police and fire as well, so we're looking at 4 different plans, 4 different asset allocations already, having one that's broken out with the Tier 2 and structuring either a more aggressive or more public equity reliant portfolio for those Tier 2 assets is something we can certainly do. We also wanted to take a look at peer information. So this peer group has about 100 funds in it. This is all self-reported information. So you'll see that the sort of universe of funds that reported their separate emerging market equity allocation is only 8. So take some of this with a grain of salt because everyone classifies their assets differently. But that said, I think the major takeaways are that the federated plan has a lower allocation to U.S. and total equity assets, a higher allocation to alternatives. And you can see that hedge funds and private equity are 2 of the higher alternative areas. Real assets and real estate are sort of middle of the road or lower quartile. So, you know, that's historically in the time that we've worked with the federated plan been the preference because of the experience with the global financial crisis is to be less risky than peers, and that's manifested itself through less equity. That said, that is the direction that peer plans are moving. So from that same organization, the National Association of State Retirement Administrators, they have over 100 plans as part of their peer group. Having more assets in alternatives has definitely been the way that peers are moving. A lot of that is because of what we've talked about with declining expectations for returns in public markets assets. I mentioned that the potentially varying goals between Tier 1 and Tier 2. That's mainly a function of what decisions you make on the actuarial side. We are confident that we could structure the portfolio for whatever discount rate and liquidity profile you'd be interested in if you do decide to separate out the assets. We then go through a variety of other types of risk analysis for these different asset allocations and historical scenario analysis and stress testing. We do this type of analysis to see, you know, does it tell us what we would expect? And in this case, it does, which is that the higher return that you target, the better we'd expect the plan to do in up market environments. When equities are going up, the worse we'd expect it to do in a downturn. And these projections are not for your specific managers because we can't say how Artisan Global Growth or Value is going to do in one of these environments. We can say how global equity as a whole we would expect to do in different market environments. So at first we have mean variance optimization-based risk analysis that shows what we would expect the worst case scenario returns to be in any given year. Also the probability of experiencing negative returns. And you can see that, you know, typically when you have a bad market environment, it washes out over time. We wouldn't expect any of these scenarios to have a 20-year negative return because we have always recovered from downturns historically. And then also the probability of achieving your assumed rate of return, which goes up with the riskier the portfolio. Looking at scenario analysis, we've looked at 10 different market environments here. They're all a little bit different. I know a lot of folks currently are concerned about stagflation, an environment where we have low growth and high inflation. Those are those 2 scenarios on the bottom and what you would expect the negative returns to be in those scenarios. And then we also show a smaller number of positive scenarios because we're always very focused on the downside. And you can see here, for example, we had the global financial crisis where your current allocation we would expect to be down 23%. However, when that recovery happened, assuming that you stayed the course with your asset allocation and didn't, get spooked and make it less risky, would expect a recovery of 27.5%. So historically, when we do have a downturn, assuming that you stay the course with your investments, typically we do recover. We then look at stress testing, and these are expectations for potential forward-looking returns. Go ahead.
Could I ask you to slow the pace a little bit?
Oh, sure, of course.
I understand what you're saying when you're saying it, but
Yeah.
I'm not having time to.
Yeah, and I am, one of the reasons that I'm not spending too much time on these slides is that I don't want anyone to put too much stock in these specific numbers, because we cannot, on the actuarial side, you have a lot more hard data. You know how many people are in your plan. You know what you promised to pay them. There's a lot more modeling that you can do. These numbers, I really want to highlight. We want to look at relative differences, not the actual number. So in general, the outcome of this analysis is that if you move to a riskier plan, you will have a higher probability of meeting your assumed rate of return. You would have very strong returns in upmarket environments like we've had recently. However, there is the risk that we have these other negative market environments that we've experienced in the past, or some that we haven't experienced yet, and then you'd see more of a downturn. With that, I think 23 is a slide that makes sense to look at. One of the things we've talked about with your staff, and we've read your grand jury report for the plan. One of the considerations in there was that sort of takeaway that was stated is that there were too many managers in the plans. And so we wanted to do an analysis, because our feeling is that you actually have a pretty concentrated high conviction portfolio relative to peers. So we wanted to look at the actual numbers. So on page 23, you can see that the federated plan has 27 public markets managers. That does include passive index funds and also hedge funds. So some people wouldn't consider an index fund to be a manager, but for the purposes of full disclosure and full counting, we wanted to include passive funds as well. And then the number of private markets managers are 40. So that includes every underlying investment. You have moved to a direct private markets program from a fund of funds, so each of those funds is its individual line item now. So that brings the total plan to 67 managers right now. So there were a few plans that were mentioned quite a bit in the grand jury report as peers. Those were LA Fire and Police Pensions, Lacers, and Lacera. We at Makita work with Lacera. The other two plans use other consultants just for purposes of looking at peers. So you can see that each of these plans has at least 10 more public markets managers. If you look at private markets, each one has more, with the exception of Lacera, because a lot of that is sort of hidden through the fund-to-fund structures that they use. So in terms of total managers, no matter how you slice and dice it, San Jose Federated has fewer than these three other plans that were mentioned quite a bit in the grand jury report. The bottom bullet point on this page talks about direct private markets relative to fund-of-funds. So if you hire a fund-of-funds manager in private equity, you're just hiring one manager. And say it's Abbott or Pathway. There's a lot of different fund-of-funds managers out there. And so they're going to hire a bunch of underlying funds. So you're paying them, and then you're also paying all those underlying funds. If you have your staff and your consultants and everyone select direct partnerships, you're only paying that direct partnership. So you're saving money. And if you look at historical returns over time too, historical returns for a direct private markets program have been much stronger than a fund of funds, in large part because of that double layer of fees, but also because you're not over diversified, you're investing in high conviction names, and of course you need staff members that are knowledgeable enough to be able to select good funds. You do currently have that full staff built out in place that's selecting direct funds. So that's the biggest determinant of how many managers you have in your plan is whether or not you do direct private markets, which have a lot of benefits in terms of fees and returns, or you hire one fund of funds, essentially farm it out, and then it's going to just show up as one line item on the report. So I think for somebody who's not in the investment industry and sees the report that's put out to the public that has private equity managers as one line item, that looks like one line item. And then if you dig further into the public data that's out there and you find the report for that private equity portfolio, you find that there's potentially hundreds of underlying managers in there. So we just wanted to provide this information as sort of to sort of arm the board members with more information should you get questions on this particular topic.
And it's not necessarily apples to apples.
No.
Because to the extent someone uses fund to fund, they might have less staff, less contracting, but they're paying more fees.
Right.
Right.
Or they might just not, I mean, something you could do in your reporting is just have a line item that says private equity portfolio, and that's what a lot of your peers do, so that if somebody doesn't pull up the report and say, oh my gosh, there's hundreds of managers in here. And that's something that's, reasonable as well. In terms of takeaways.
Mr. Roberts, do you have a
Oh, go ahead.
Well, maybe you want to wrap up, and I have a number of questions, so.
Okay. Yes, we're almost finished with the main part of the presentation so that we can have a discussion. In terms of lessons learned, I think, we've read through the grand jury report and would agree with, as I'm sure, everyone here would, that there is some duplication of efforts required with the two-board structure, and that there was a decision to be more risk-averse, and that's led to poor returns relative to peers. I think, some of the bigger lessons learned that weren't in the report were just around what we talked about the shifts in asset allocation. With the shifts in staff and board members, different folks take, different tactics to try to get to the assumed rate of return. And because of the necessity of spending a lot of time investing in new strategies, trying to get out of new strategies when that changes, having a long-term perspective and hopefully a staff that is now fully built out and stays in place over time, to us is a really huge determinant of success over time. So happy to address all your questions.
Sure. Well, going back to page number 3, showing the history of where we've been.
Yep.
It sounded like you were associating the different asset allocations through the various columns with changes of CIO at the pension plan. So I guess my initial question is, who's driving the changes in asset allocation? Is that driven by the board or by the individual CIOs?
Sure. So asset allocation is the responsibility of the board. That said, the board, is involved in the hiring of the CIO, and different CIOs have different, initiatives. And there were periods of time where there was not as many staff members as everyone would have liked, and a lot of turnover. So I would say that, it's a collaborative effort when asset allocation is changed. It's by a vote of the board, but it's heavily driven by staff.
And Laura, between you and Mr. Polani, could you talk about the division of labor between the CIO and the investment committee?
We can talk about definitely how it is now. I can tell you that in some periods in the past, it's been very different. For many of our clients, there's not a staff, or there's a smaller staff, and it's very collaborative. I would say we're very collaborative right now. With a couple of CIOs ago, there was a different sort of operational culture, I guess, and there was a lot that was driven by staff, and sort of we were asked a question when there was a need for that, rather than being really involved in the process.
If I may add, so we did a governance project with Cortex last year, and those recommendations were accepted by both boards at the end of last year. And so for the first time, we've actually, hopefully, we'll see how this works in practice, made it very clear that the responsibility of asset allocation rests with the board. But practically speaking, as Laura mentioned, The investment consultant and staff work together, and we come up with a number of options. And you saw 4 options today, A, B, C, and D. We actually presented 8 options to the IC. And then the IC recommended that we take 4 options in front of the full board. So at the October board meeting, you will get those 4 options, including the current, where we stand currently. And the board will then get to discuss and vote on one of those options. And then it is our responsibility as the investment team to implement the option selected by the board and to pick the underlying managers.
So the changes that Laura alluded to just a minute ago between the different regimes, different tenures, that's now all been codified through the governance?
That's right. Now it is part of our it's now codified in the investment policy statement.
You've delegated authority for manager selection to the staff, which in our opinion is good governance. This has always been a great board to work with, but at different points in time, staff and Makita would bring suggestions, and there were, certain board members that, said, you know what, I've heard bad things about this asset class right now, or in my personal work, I'm not recommending this asset class, and so let's not do it. So that leads to a lot of sort of disconnect between the strategy that we're all trying to carry out. So I think, adopting an asset allocation that makes sense, which drives the majority of returns, is number one most important. Implementing that and leaving a lot of that to the folks who are day-to-day meeting with investment managers and paying attention to markets makes a lot of sense from a governance perspective, and that's where you are now.
Mr. Lederman, and then I see Mr. Horowitz wants to talk.
I was going to address more directly from a historical perspective Spencer's question. There was a period of time several years ago that for a lengthy period of time the board had set asset allocation, and for various reasons at that time there was only a single investment officer, and the board's asset allocation was not timely implemented because that individual had a very different view of how the investment should be made. And so as a consequence, the board's determined allocation simply never went into effect with the consequences that followed from that. We have now in place rather robust governance principles and monitoring of that to avoid those situations and to more timely implement the board's determination.
Okay. Mr. Horowitz, did you have?
Yeah, I have a couple of questions. So that certainly gets to the first issue. My next question is then, how frequently is the asset allocation rebalanced to bring it back up to the preferred determined asset allocation? Is there a methodology for that?
We are actually at the asset allocation currently. And so there is a mechanism that's built into the IPS where if we deviate more than a certain percentage from the strategic asset allocation for each asset class, we will immediately rebalance to the asset allocation. So you will not see any significant deviations from the strategic asset allocation policy.
So the question was about a time. It's actually a metrics based on the amount of deviation from the strategic, not like every 6 months or every 2 months. It's based on what swings there are going on in a particular asset class.
Right. So that I infer from that we have the ability then to quickly respond to rapid changes in asset class valuations, i.e., if the market were to go down sharply, we would respond quickly to bring our asset allocation back up to the preferred level, thereby capturing the potential gains when stocks are on sale.
Yes and no. So if there is a sell-off in one asset class relative to other asset classes, that throws off the asset allocation, right? And therefore we would rebalance. However, there could be a situation where there's a sell-off in equities, but similarly, there could be a similar move in bonds, and therefore it doesn't necessarily distort the entire asset allocation. And in that case, we would have to come back, the consultant and staff would have to come back to the IC and suggest changes. And the IC does not have the authority. So what we can do is we can discuss this with the investment committee. Then the investment committee can then say, we should take this to the full board to make changes. And part of this was done deliberately as part of the governance project. There was a feeling that staff was not adhering to the strategic asset allocation. So we wanted to make it very clear that the board sets our strategic asset allocation, and it's staff's job to actually stick to that strategic asset allocation. Any change that staff wants to make will have to be approved by the full board. So there could be some timing issues, as in, when does the next IC meeting take place, or when does the next board meeting take place? And there might be, and maybe Harvey can comment on that, and if need be, if in October 1987 happens, maybe there is a mechanism by which we could come to the board, convene the board, or make a decision on changing asset allocation rapidly. I don't anticipate a situation like that, but.
I'm not suggesting changing asset allocation, but rebalancing quickly, which is a little bit different.
Yeah, the rebalancing happens automatically, but if you're saying that equities are on sale, and now we should move from low beta to equities, that's an asset allocation shift. And that would require the board's approval.
I guess what I'm kind of hearing is, I don't think we do any tactical.
We don't do any, that's right, we don't do any tactical moves. The investment team does not have the authority to make any tactical asset allocation shifts.
Right, and again, I'm not suggesting that would necessarily be a good idea, but when the asset allocation will change rapidly if there's a rapid reevaluation in different asset classes. And our ability to respond to that quickly, I believe, will do much to increase our returns over time.
You are right.
Yeah.
It has the potential to increase returns.
Yeah, no, it's a great question, because rebalancing back to targets is the number one way that you capture the bounce back after we have a negative market environment.
This is what I'm suggesting, so.
Well, the question, I guess, what is the definition of rapid? Is it?
I'm sorry,
What is the definition of rapid? Is it a rapid rebalance? What is the right time? I mean, that's where you get into how quickly can staff make moves to capture or to rebalance. Rebalance to capture. It's not how quickly can they do that? And that's probably the right question. How quickly can you rebalance the portfolio?
Right.
Staff does have some tactical capability, because basically our asset allocation is set with a target, but within ranges, high or low. And so within those ranges, staff can make some limited tactical determinations. Also, the liquidity of the portfolio gives us the opportunity to fund those kind of situations. And of course, the judgment call always is going to be, are you trying to catch a slippery knife, or is it really a buying opportunity? And that's why we have professional staff and consultants to try to give us the best views they can of those situations. But there is some limited tactical capability there to go within those ranges.
But I do think your governance structure currently would protect from a lot of the things that were pitfalls in the past.
Okay. It sounded like in the past, implementation under different CIOs was to resist or ignore or somehow to frustrate the asset allocation determination and not to rebalance based on judgment calls.
Yeah, I don't know if I'd, I think everyone's.
Maybe I haven't used the right words to characterize it.
Yeah, I think markets have been expensive for a long time. I think a lot of people could point to, look at where the PE ratio is for U.S. equity, and you could point to it 5 years ago, and you could point to it 7 years ago, and you could say, we're really worried about a coming downturn, and so therefore we're going to overweight fixed income and cash. So I think everyone's heart was in the right place. But that said, the asset allocation, it's not so much that the asset allocation hasn't delivered what it was expected to, but that we weren't there, so it couldn't.
and weren't there means,
It wasn't implemented the way that the asset allocation was adopted.
More questions, Mr. Horowitz? You said you had several.
yeah, turning attention to page 11, it seems to me this is the critical page, and I think a lot of our decision-making is being led by the data presented here, especially with respect to expected returns and standard deviations. And I think if we look at your appendix, in some asset categories, we have probably some very good data about potential returns and historical returns, and because those are marked to market. But in a lot of alternative classes, these are not marked to market. And so the expected returns is, well, somewhat speculative. I mean, speculative, not that it's a speculative investment, although it very may well be, but speculative in the sense that we really don't know that much about what the return to hedge funds or private equity might be.
There's a lot of execution risk with those asset classes relative to just, market risk.
And I can't help but note that the standard deviation for a simple 60/40 portfolio is substantially less, according to the Makita numbers, than any of the alternatives currently considered. Would you care to comment on that?
Part of that is the relationship between risk and return. It also has a lower expected return, so we'd expect it to have a lower risk. Part of that is also the way that we develop our assumptions. So for private markets assets, they're only valued, to your point, usually every quarter, if that. And so it's going to look like private equity and private debt and private real estate have really low volatility. Really, that's just an accounting issue, why it looks low. And so we sort of artificially inflate the standard deviation for private markets asset classes so that our optimizer software just doesn't steer everything toward them because it appears that they have such low volatility. So the expected standard deviation for allocations that include private markets is going to be higher than what we think you'll actually experience when you take an Excel spreadsheet and do standard deviation. But we think it's more useful for decision making.
I guess I'm curious if one were to also compare a slightly higher equity allocation, let's say a 65/35, would that not achieve a similar expected return but at a lower standard deviation to options A, B, C, and D?
So if you increase the equity and decrease the fixed income, your standard deviation is going to go up just because equity has a higher standard deviation.
Right, but
But it would still be lower, likely,
Thank you.
than the ones next to it. Yep.
Exactly.
Okay. Other questions? Comments? The audience dwindled, so I don't know if there's many in the audience who have questions.
We think we're more interesting than the actual.
It's not a competition. This isn't a popularity contest.
May I ask a question?
Yes, please.
If I may, Laura, just a question. Just looking at your median expected returns, 10 years and 20 years. So what is it that causes Makita to believe that in the out 10 years that the performance will be significantly better? And when I say the out 10, to go from let's just take the current cash, the first column. If over 10 years the expected return is 7.2 and over 20 years it's 7.7, that means in the out 10 years you're actually saying it's going to be 8.3 or something like that. And that's across the board. So can you tell the board, explain to the board what gives Makita the confidence that the market is going to outperform that much more in the 10 years out than in the forthcoming 10 years?
Yeah, I don't know that I'd use the word confidence, mainly because, we have no interest in whether or not you steer assets to one asset class over another. We don't manage any assets. Our fees don't change.
Right.
It's actually easier for us if you pick a way risk-averse, portfolio because you have a higher likelihood of hitting it. But I will say, it's not a confidence situation, but based on the data, and we've been around for 40 years and developing an asset class study every year for 40 years, which is primarily driven by valuations. Valuations are very high right now. So if valuations are high, typically in the next subsequent 10-year period, we're going to have some sort of correction. Once you have that correction, the chances of continued upswing after that are higher. So it's based on the data, the historical data, expectations for the future, and the fact that because valuations are high, we'd expect returns to be more muted in the short term than in the long term.
So it's just a reversion to the mean?
That's a big part of it. That's not the only thing that we look at, but that's a major part of it.
So would you then, on your chart on page 9, have said in 2009 that we expect in the first 10 years to 2019 will look like the red line, but that 10 years beyond that, it's going to revert back to the blue line of 2009?
I think you're thinking about that correctly. I think you might have worded it oppositely in talking about which line, but yes, in 2009, we would have expected much higher asset class returns coming off of the recession, and then in the following 10 years, we would have expected lower asset class returns.
But that's not what happened.
So these are based on the projections. So we have had much stronger equity returns in the last 10 years than we would have expected.
Right.
Yeah. Based on the data.
Okay. Thank you.
Sure. More questions, comments?
Well, I want to throw one point out, because when Kyra was conducting their presentation, they asked the question about asset management in the commingled stage. I thought it might be less, it would be more confusing to have the assets in Tier 1, Tier 2 commingled if we started down the track of using different kind of required rate of return structures for the tier. And then you said that would be a question to discuss at this time.
Ask your question.
So, what? I'm not so sure how I'm going to kind of structure. So, if we decide to choose a different path for Tier 2, let's say we have two different required rate of return, pre-employment and post-employment. We decide to have all the assets commingled with Tier 1. Is it feasible for you to still come up with an asset allocation for the aggregated plan? Or is it easier for you to separate plan into two different pools, separate the assets into two different pools?
So if you were going to have different expectations for return that you were trying to hit, it would be simpler as for everyone to monitor and set an asset allocation if you did not have the assets commingled. Currently, we're looking, we're accustomed to looking at different plans for you and for other clients where it is commingled, and as Chiron mentioned, it is unique to break those things out. But certainly, we work with many clients where they have different pools of assets that target different returns, and we develop individual asset allocations. So that's certainly something we could do.
So in a way, it is cleaner and simpler if you.
It could be cleaner, yes, definitely. I think, like I mentioned before, I think you might end up paying higher fees and wouldn't have the same access to certain investment vehicles just because the asset size would be lower. As it grew over time, that would change.
Yeah.
Okay. More questions, comments? Okay, thank you.
Thank you.
On to item 3. This is discussion on a timeline and process for developing board's annual work plan.
Thank you, Mr. Chair. So, as part of developing the retreat, one of the questions that was presented and stated was, hey, how come the board doesn't have any input on the work plan that is completed, that is expected for the following fiscal year? And so the goal of this memo is to kick off the basis and the discussion for helping the board develop a process for which they can join the work plan discussion, so that in addition to the staff work, we get input from the board if there are any particular mandates or issues that would like that work plan for the following year to be included there. So what we did was we aside from the memo, which just gave some basic background, what we did was we provided 2 attachments. As you can see, one is actually a calendar year timeline for our office. They're designed, they're different colors, but we went by month as to specific board agenda items that come before your board for discussion, issues related to the retirement office operations, and then events or timelines that we have to follow as an office when we are dealing with issues that are related to the city council and the budget office. So you can see that. I won't go into the specifics, although I'm happy to answer any questions, but I think the easiest one to deal with is the budget process. And because the budget is actually approved or presented to the city council in May, actually fully approved in June, we work backwards from that, and we make sure that we come before your board in March. And before that, as part of the process, our office work within the city structure is considered an appointee office. So we work with the mayor's office. That means that then I start discussion with the mayor's office either in December or January as to what are our potential needs for the following year. So that was just an example. The second attachment, it just kind of split a discussion or a particular event or item on whether they may have a potential impact on the budget or not, because it makes a difference. If it's a work plan or an issue that wants to be implemented that does not have any budget impact, then we have more flexibility as to when we want to have those discussions, because it doesn't have to be part of the budget process. But if it does require to make sure that we request budget dollars for that particular initiative, then we want to make sure that we work through the budget timeline process so that by the time it is discussed at the board level with staff, it can be part of the process that we use to present the budget to your boards in March and eventually approve at the city council level in May. So again, what we were trying to do here is sort of provide you with the timeline that we use at the office so that then the board can use that approach. And again, this is a kickoff discussion so that at future meetings, if there are particular initiatives that you would like us to include as part of the work plan for the following year, that those discussions take place timely at the board level so that that information can be then input into our process to develop the work plan for the following year. Now, I know before, if you have any questions or comments, I'm happy to address them. I did discuss these issues, obviously. I met with Trustee Son and Castellano when we developed the agenda. I also know Trustee Castellano has some further comments. This particular approach was to help your board get into a process for develop a work plan for the following fiscal year. I know Trustee Castellano was also interested on kicking off a discussion on how we can take this kind of process and then use that as a basis to develop a more strategic planning process for the full board that, of course, take into account more than just 1 year. So I just wanted to make that point because I know he has some comments on that as well.
Yeah, thank you. Yeah, so Trustee Sun and I were an ad hoc subcommittee of sorts to work with staff in preparing the agenda for this retreat. And for this particular item, my input was that as far as I know, we don't have the board doesn't have a strategic plan, as in mission, vision, that kind of thing. And I think the value of that is it's really not necessarily the output that we would get from that, but rather the discussion, the conversation amongst ourselves. I'm not sure, for example, that all the board members, if you were to ask us individually, what's the mission of this board? I'm not sure we would all have the same answer. what's the vision for the future for this board? I'm not sure we'd individually all have the same answer. And so there's and I think there is a value in having that conversation so that we all are thinking about where we should be going. And the other added element to that, I think, is is where are we at with regard to the mission and vision? Are we doing well? Are we already there? Because that delta would dictate where we would want to put our board agenda priorities. So I don't have a thought right now about where those priorities should be. I think there's really a conversation to be had beforehand. Again, mission, vision, and then a current state. So my interest on this agenda was to have a conversation about process. What can we build in to what the board does on an annual basis? And it definitely makes sense to work around other processes like the budget process, so that to the extent we do have a priority that requires some kind of funding or some other kind of alignment, then we can build into the budget process, for example. But it's really about having a process, whether it's an annual or biannual process of looking where we're at and what we need to do to close the gap. I mean, I think that probably each one of us, if we envision successful organizations of which we've been a part, there is a plan, there is some sense of where we should be and where we need to be, what we need to do to get there. So I'm just suggesting that we do something similar in this body.
Comments, questions? I don't know what anybody's going to say. No, we shouldn't plan anything. This is a horrible idea. It's the dumbest thing I've ever heard, Jay. We should just willingly go month by month and figure this thing out. So, yes, planning is a great idea. I don't think I should weigh in a whole lot on that because I could tell you the last 10 years has been pretty interesting because the problem sets we've had to deal with have come out of left field almost every year. And having to implement so many different things and kind of right the ship on so many different things going on, it's been, I would say it'd be pretty damn impossible to come up with a plan that we could have implemented and stuck to it for 3 years. I think if you just looked at the last presentation of what we've had to deal with staffing around CIO implementations and asset allocations, we could talk over that. If I project my best Drew Lanza over many, many beers and have many interesting discussions about how these things actually came to fruition. So again, I think 3 years would be kind of a stretch, but I think we're hopefully also coming into an area of a bit more stability. It's feeling like that to me, that we're into a period of a bit more stability, mostly because for the last 10 years it's been kind of a crazy ride. And so it feels more stable now, and so it potentially could get to a 3-year plan.
I guess I'm wondering, are you suggesting a process that would take place outside of the normal board meetings? This would be some sort of a ancillary process? I'm not quite sure.
So the only thing I would recommend, only because of having to have scheduled so many of these things, I would recommend, knowing the Federated Board, that we should do them, allot time during board meetings to do something like that. If we wanted to have a separate retreat, a strategic planning retreat, it sounds like a great idea also, but because of how hard it is to get people's schedules, if we all know that every third Thursday we have to be around each other, and most people then block off their 11 of those days through the 11 times through the year, that schedule it around those times or push it to a lighter agenda. And so you can move some things on the agenda. So we have a good hour and a half, 2-hour time to kind of work on that and then iterate throughout the year. That would be my recommendation, but some people like to have longer times outside of the board milieu and have a different concept.
On that point, when do we see the next calendar for the upcoming year, for 2020? Is that coming up soon?
We actually did
it?
that at a prior board meeting.
Oh, I just didn't see
We
it.
may bring it back because we have to change your day for the January meeting. We had changed it from the 16th to the
something. Yeah,
23rd,
yeah.
but now we want to make it back the 16th.
I'll just keep an eye
I
out.
hope I don't go back to the 23rd, but right now it's the 16th.
It's either the 16th or the 23rd.
Yeah. So we can bring it back, but that already, yeah, we did that in, I think it was August.
What process would you like to engage in?
Well, to answer trustee Horowitz's initial question, I think I'm envisioning in board meeting work for the same reason that Chair Lush mentioned. Time outside of the meetings is difficult, especially when board members already have committee member assignments. That's plenty of meetings every month for the group. I do think that to the extent we haven't done this before, and I get any sense that's true, then.
Well, I would say this, there's work plans that are established by both the operational investment side and more broadly. So there are work plans that I think could then be massaged into something longer term.
Yeah.
I mean, we've been doing this whole pension administration system revamp for 4 years. We've been doing, bring out a new CIO, we go through a whole org and things on not just that, but also governance around that. So there's been many of these longer term initiatives that have been in play. Have we documented it in something called a strategic plan? There's work plans every year that you could take those and shove those as a first go as to how would you do this. And so not that no planning is being done. Mr. Pena comes in every year with these work plans for the different work groups underneath, and those things are there. You could take that as a first cut, and they've sort of been aligned year to year, but it hasn't been beyond year to year.
You are correct, and but I want to make a distinction. I apologize, Mr. Castellano, I don't mean to interrupt you. So I'm hearing two things, but I just want to, I think you're keying in on the vision and mission, and I think that, you know, if I hear you correctly, you may want to kick off with that first. It seems to me that what you're saying is you want everyone to be on the same page. We need to know what our mission and our vision is, and then as we move along and work on developing a process, we want to, from time to time, check in where we are compared to what that goal is. And until we have that discussion with the full board, it will be hard, other than what Chair Lush indicated, that, you know, we can kick off and take a look at where the work plan is and where we are, but that's not going to answer your original question.
Right. Yes.
So I just want to make the point that two different issues, and I think
right.
The vision and mission, we can do that on a regular board meeting for sure, but I think that if we are going to do that, we want to do it at a meeting where we want to emphasize that's the main objective of the meeting.
That'd be interesting. Right.
Aside from other issues, and again, I'm sure you can see the actuary, he's not smiling, but he is so excited because for the next 4 months, he's going to be before you every month between October and January, either talk to you about valuation for the pension plan, or the OPEB, other post-employment benefits, and then we're going to throw in the new Tier 1 and Tier 2 options in December.
Just Tier 2 options. There's no Tier 1 options.
I'm sorry, Tier 2 options, which Chair Lodge promised me he will be watching in December. In any case, so I think first step is let's think about when is a good time to do that. Of course, we can do it in the next few months, but I mean, we're going to be so busy the next 3 or 4 meetings. I think we want to kind of set a time where that will be the main discussion at your board meeting, which really, to me, seems like sometime in the early 2020. Hopefully, you know, to build from there.
Well, my recommendation, again, it'll seem funny, is to push the initial conversation to December. And because then you'll have, I know why you're laughing, but it's the wrong reason. It's really because then you'll have the full assets of all 7 trustees, and all the new trustees will be in place. You know, so we'll be talking about the 7th person next meeting. Hopefully they'll be in place by November. The person to replace me hopefully will go through an employee election and be placed for the December meeting. So you'd have the full confluence of people that will be with you for 2020, and at least have initial discussion. You might finalize it in January, February, but I think certainly to get folks around having some discussions, it's probably hard to get done in one meeting. And certainly people want to ruminate on these kind of things and think and and noodle on stuff. My recommendation is to kick off some of that discussion as early as you can, and so it doesn't sit and fester. But that, again, I won't be there to decide. So
right, yeah, and I definitely I agree. I forgot to acknowledge that, yeah, there is good planning going on now. It's like, I'm not comfortable that it's happening at the board level with the board's interests, with board focus. The administrative work plans are great.
Well, the one thing I'll say is, 4 hours in, several months in.
Yeah,
and
right.
About a year
That-
in.
and
So
that-
it's like there's a lot of that that's really the reality of it. And it's not it is the reality, so it is what is. And so I think if you there's a reason why it feels awkward.
Yeah. And,
I think that's part of it.
yeah, that's part of the backdrop too, is that after Chair Lesh departs after the November meeting, Trustee Chandra will have the most seniority at 3 years, and everyone else will be
Less than a year.
1.5 years or less.
Yes, that's right.
So that it'll be helpful to have
Change is good.
some kind of plan.
No, but-
And I think too, just like pension plan asset allocations, this is gonna move slow. Because we could come up with mission vision stuff in a meeting, but we've got a lot of stakeholders that need to
Buy in,
see it
yeah.
and buy into it, and it'll need to be massaged.
How long
before we
did,
can start building
so
around
when
that.
PNF put together their mission statement, how long did that take? They've got their mission they worked on that for a bit. Drew was a great wordsmith on that. And there's stuff that, so PNF spent a good amount of time on it, and they were very contemplative about their approach. And so potentially you could also start from something that's already known.
But in terms of timing, I agree that, I remember last year, it was a very busy time of year, so, but perhaps the staff can start to show us a process so that early 2020, when we're fully staffed board, then we can take a look at that.
So what I'm hearing is direction to you guys that lay out the plan for working on this. And
Yes.
come back to the board for what that looks like.
We'll do that, and just to be clear, we can bring that to a future board meeting, and we'll have agenda reviews, meetings, so we can talk about the agenda, but towards the early 2020, you want something, you as in the board, you would like to have a plan to have some discussions at the board
I'm not hearing
level.
that. I'm hearing the plan earlier so that the work is going on then around it, so that the board has capacity of time to work on it. Is that, so it's not present the plan for the time in 2020. It's be ready to be working in 2020 on that plan. So present the plan earlier. Like, I think if you can come back in November with, this is what we think we'll be working on this part, present the plan in like November or December, and then you can start working at it in January, February.
I just want to make sure that it's clear, because I think we are listening or thinking about different things. I just want to confirm again that the main goal to kick off the discussion is to establish a mission and a vision. Is that?
That would be one of the earliest products.
Well, yeah. So my goal will be to first get all of the board members together and understand what are we here for? What is the mission? Because I think that's going to drive everything else. As opposed to start working on some other kind of process, then to start thinking about what our mission is. And so that's what I was coming from. And then establish or have an actual discussion at the board level to come to an understanding of what is it that we're thinking, as opposed to come forward with to you board with some suggested process, which maybe some board members will ask some questions. Well, we're not really sure why are we doing this first? Isn't this our mission, or isn't this what we want to do? So I just want to clear direction on that. That's
So,
what I think.
let me take another shot at it. Maybe it's saying the same thing, but I'm envisioning that you would build a process that would generate certain products along the line. Early on would be mission and vision, mission statement, vision statement. That would be part of those would be outcomes of a process. But the larger process, I think it would be good if you can show us what that process looks like in the November timeframe. And then we would start to execute that process early in 2020 when we have 7 trustees on the board. So the process would start in early 2020 after the bulk of the actuarial work begins to subside, and then we can start to generate products using that process, but that whole thing would start in 2020.
One last question, not to be difficult. I think when Chair Lodge was talking, saying 2020, I think he may be referring to calendar year. Since we put a work plan for the fiscal year, do you want that initiative for the calendar year 2020, or do you want to kick it off for the fiscal year 2020 just to be in line with our work plan that we work every year? I mean, to me, that may be easier, because otherwise, you may have some initiative now in 2020 that we didn't even think about before. If the priority to the board, we certainly can change gears and do something different, but it may have budget implications that we didn't anticipate. So the question is, do you want to stick to the 2020 calendar year, or do we want to stick to a 2020 fiscal year?
I think 2020 calendar year, I think that's, we'll have capacity, we'll have the capability at that point. And then we can, we can see how the process that you lay out in November, we can see how it lines up with the budget process. I know the budget process, you've got to have proposals in place by the March timeframe, I'm gonna guess something like that. So I'm envisioning we're only going to hit pieces of the process during our regular meetings. I'm not envisioning we're going to have something in place by March in time for budget.
I would recommend not deviating from the fiscal year plan, but that's yours to decide, not mine. So fiscal year makes it easy, because that way they have things that they have budget for, but, open for your interpretation, not mine. My recommendation would be stay on fiscal year, because that makes easier for staff to actually be able to implement if budget's needed. But again, you're going to have 6 months worth of remaining budget, but really you only have, if you need budget for the following fiscal year, you need to have that decided by February at the latest, because it takes them that long to get through the machine.
Yeah, no, and I do understand. I'm very mindful about the budget process too. I'm just saying there will be the opportunity in early 2020 to get started on the work, and if the work takes 9 months, for example, I'm just making that up, but if it takes 9 months and there is a budget aspect to the implementation, then we'll just have to wait for that next cycle.
All right, very well.
Other comments or questions on it? It's been a hearty meeting. Lots of heavy topics. Anybody want to recycle some of the actuarial fund? I'm just kidding. Future agenda items? Public comments? We're adjourned.